the kind of economic activity that we are seeing now is somewhat unprecedented.
The inflation story for us, maybe it peaked in June.
It is virtually impossible to craft a story where inflation comes neatly back down to 2%.
I think a lot of countries are having to react because inflation goes up when the dollar strengthens.
When you think about what's going on in Europe, I think the worst case scenario is priced in.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
Live from New York City for our audience worldwide. Good morning, good morning. This is Bloomberg Surveillance on TV and radio. Alongside Tom Keene, I'm Jonathan Ferro. Together this morning with Katie Lyons. Bramo back. I hope next week. We hope, Tom. Is she back?
Yeah, we
Another
heard
week's
from
vacation, maybe?
John, we heard from a listener in Nepal who saw her.
There we
Bramo
go.
on the edge of Everest. She's past Camp 2, past the ice fall. And I don't know, she's not near the death zone yet. But to the gentleman from Nepal that greeted us this morning, good morning from all of us at Surveillance. And yes, he thought you and I were on speaking terms. John, I agreed with him. I said, yeah, that would be true.
We'll get an update from Bramo hopefully later this week. Futures up by about 0.7% this morning. TK, that dollar's weaker. That euro stronger, back through 102.
Yeah, and help me here with a parlor game on ECB. Are we really having a parlor game about how much Lagarde's going to lift? I don't buy it.
According to sources, maybe by 50 basis points. Tom, whether it's 25 or 50, the bigger conversation once again, how small is this window for this ECB to hike interest rates in? Given what people expect will happen with growth later this year, and given what may or may not happen next week on Thursday when Nord Stream 1 is meant to come back online, the European Commission said this morning, Tom, it's a short quote, it's pretty straightforward. We don't expect that it comes back.
In addition, John, the window of the heat wave. Do you just assume, John, that what we're seeing once in a century, once in a lifetime, 300 years plus in England, diminishes economic growth, right?
I'm not a meteorologist, Tom, so I'm not going to assume anything about the weather. But when it comes to growth, I think if you're in London and you don't have air conditioning, Tom, I imagine your activity is going to be lower than it otherwise would be.
John, just from the Telegraph here this morning, I was absolutely thunderstruck at 25 degrees Celsius at night. The doctors say that's the most important thing, John. That's an unimaginable 77 degrees in London at night.
Brutal, TK. One more day of it, and then it's going to get cooler over the next couple of days.
So we'll go next weekend.
It gets hotter here in New York City through
we'll
today,
go next
that's for
weekend.
sure.
Road trip.
Go next weekend. You put that in the diary, Tom, after Frankfurt. And where did you want to go? Rome as well, to check in on Draghi?
I think we should go to Rome and be sure Mr. Draghi's feeling okay.
I bet you do. A little bit later, we head over to the West Coast because, Kaylee, we have to talk about Netflix earnings after the bell.
Yeah, this is going to be an interesting one, considering after the last earnings report, the stock dropped 35% in just one day. It's down by more than 2/3 just on a year-to-date basis, and we're expecting they lost 2 million customer subscribers in the second quarter. So the real question is going to be, does that get better in the third quarter, and how are they going to go about monetizing password sharing? There was news overnight that in Latin America, if you want to add an additional household onto your account, they're going to charge you for it. Netflix really trying to figure out how they can bring those dollars in.
Let's keep it on tech and go to Apple too. Kaylee, what did you make of that? It's next year. It's slowing hiring in some places next year. Are we making too much of a big deal of that?
Well, it is interesting how it was able to turn around sentiment in the entire market, given everything you just said, John, the fact that it is only some teams. It is slowing hiring. It's not outright job cuts, but you have to take it in conjunction with what we've heard from other big tech companies that are also slowing hiring, or even in the case of the likes of Microsoft, cutting jobs outright, at least in some teams. So all of it kind of adds up to a signal that even these tech giants that in theory are a little bit more insulated from macroeconomic pain are still bracing for it.
It's Apple, it's Alphabet. You mentioned Microsoft cutting. Tom Goldman, you'll love this quote. You will love this quote. We have made the decision to slow hiring velocity. Have you ever heard that one, Tom?
I've not.
We're slowing hiring velocity.
One of the biggest arguments I've had in the history of Bloomberg, John, and you know I have daily arguments, Christ, you can measure them by the hour, was over the language of firings, layoffs, job cuts, and everybody's struggling for new phrases here.
Why do why do bank executives have to say things like that? What does that mean, Tom? We're slowing hiring velocity.
That means they're still hiring because they have to hire in tech or they're toast.
Exactly.
I totally thought Tom was going on a rate of change, second derivative.
That's what they're meant. That's what they're trying to say, isn't
Virginia
it?
calculus. We'd never get that from Bramo. I mean, she's calculus free.
Tom made me do a calculus primer before I ever came on.
John,
seriously?
Real story.
Oh, my God, Tom, what are you doing?
Yeah, John, Javier Blas, I'm literally writing it up, folks, in real time. That's the way we do surveillance, trying to keep up with it. Javier Blas, the giant, France electricity is something called base load, le load de basse, it's called, John.
Nice.
Up 891% since the end of 2020.
Okay, we've got things to do. We'll come back to that in a moment.
Yeah,
Futures up 0.7 on the S&P, on the Nasdaq 100 up 0.6%. I want to hear more about this calculus course to get on Bloomberg Surveillance.
It
What
is.
on earth? Yields higher just a little bit, 298.74. Euro stronger, dollar a whole lot weaker through G10. Euro dollar 102.52, Kaylee, and crude, let's call it unchanged, shall we? 102.41.
Yeah, still in triple digits, John. All right, calculus is not on my agenda today, at least no coursework or homework for Tom Keene, but there's plenty else going on today. At 8:30 a.m. Eastern time, we're going to get housing starts and building permits data. I am especially more interested in this in light of the fact that we saw home builder sentiment yesterday falling to the lowest level since May of 2020. The chairman of that NAHB survey talking about higher costs, higher rates, all of that meaning that we're seeing a slowdown in construction. So what is going to come out of these numbers this morning? Then after the bell, we mentioned this. Netflix will be reporting second quarter earnings. 2 million losses on subscribers is what we're expecting. Does it get any better in the third quarter? And how are they going to monetize more given all the password sharing that is out there? Again, that stock is down 68% on a year-to-date basis. And finally, the ultimate crypto plug here just for Tom Keene. All day long, the Bloomberg Crypto Summit is going to be taking place in New York. Of course, we'll also have Bloomberg Crypto on at 1 p.m. Eastern time. But at the summit, we'll have the likes of Sam Bankman-Fried, Mike Novogratz speaking. I'll be moderating a panel with Yatsui of Animoca Brands at 2:30 p.m. Eastern time, Tom. I know you'll be tuning in.
I'm going to break the surveillance snap. John, I mean, I'm looking at Jack Mahlers. For those of you on radio, the guy's got the hoodie on. What do you think, John? Do I need a hoodie like that
I've got
on here?
no time for that, but okay. All right.
Okay.
I'm not going to
Crypto.
comment.
John, this is the
comment.
price of having
Okay.
lines on. We have to flog crypto all morning.
I appreciate it.
I'm happy to do that. Russ Kostrick joins us now to talk about equities and bonds, portfolio manager for the BlackRock Global Allocation Fund. Russ, you have been conservative through much of this year. You have not been constructive on the equity market. Has any of that changed in the last month?
Good morning, John. You know, I think the short answer is not really. We're still in an environment where you have the same headwinds we've had for most of the year. You've got tightening liquidity, which has been a huge headwind, particularly for the growth sector. You've got a slowing economy. These have not gone away. What I would say is that valuations are at a much more reasonable place than they were 12 months ago. Globally, you've seen multiples have compressed around 30%. They're down about 40% in Europe. So I think we're closer to a bottom. I think the market's in the process of making a bottom. But all of the conditions that led to the volatility, unfortunately, they have not gone away yet.
Russ, Julian Emanuel over at Evercore ISI gives me the first look with 11% of SPX earnings in. He's got a nice inflation revenue lift, but critically, he's modeling out earnings at 4.8% growth. That's not bad. I know things are down, but is the pendulum just overestimating the gloom?
Well, it's a great question. I think you hit on what really is the big issue going forward. Again, I spoke about valuations. That's been all of the losses year to date, all of the loss in the S&P. It's all been about that multiple compression. But to your point, what really is the issue going forward now is how much is the economy going to slow? How much is nominal GDP going to slow? And what does that mean for earnings? Earnings so far through the second quarter don't look bad. The real question is if we continue to see as a result of Fed tightening, the economy slows in Q3 and Q4, are those earnings estimates in the back half of the year realistic? And this is why I think the market is struggling to break out of this range.
Okay, so if equities are struggling to break out of a range, if you are not yet seeing the signal that we've actually reached a bottom, how much do you like treasuries here, Russ?
Well, the short answer is we really don't. We're still underweight, but we dislike them less than we did a year ago. You've already chopped a lot of wood. We've seen that real rates on the long end of the curve have actually gone back to where they were in the post-GFC environment. I still think you might have more pressure as the Fed continues to tighten, but you're starting to get better real yields. And I say really where we're starting to see opportunity is in the credit markets, in U.S. investment grade, in U.S. high yield, where the spreads have widened considerably. And if we're going to be in an environment where equities are going to be chopping over the next several months, one of the things you can do in your portfolio is you can add carry. You can add income. And right now, that's an asset class where we're starting to see better value.
Are you making an assumption there, Russ, about how sticky inflation might be through the next several years, not just this year?
Well, we're certainly assuming it's going to be, difficult for inflation to get back to the 2% post-GFC norm anytime soon, which means that at some point, while the Fed may have to slow down, we're not envisioning a world where you're going to go back to this very easy environment of low interest rates, QE, which obviously was this huge tailwind for financial assets for the better part of a decade.
Russ, awesome to catch up. Russ Kostrick there of BlackRock works closely, of course, with Rick Reeder as well. Getting a little bit more constructive on credit at the moment, both investment grade and parts of high yield too. Take a listen to this, Tom. It's the Bank of America Fund Manager Survey from Mr. Hartnett. The quote was, "I'm so bearish, I'm bullish." Here are some of the lines. Record low growth expectations, record low profit expectations. It goes on. Equity allocation, the lowest since 2008. Cash levels, the highest since 2001. Tom, it is just packed with doom and gloom.
I just looked at an absolutely mediocre, world-famous mutual fund with garbage performance, and they're almost 9% in published cash. John, that's a rare occurrence.
What do you make of that line, Tom? Things are so bearish that perhaps it's time to be bullish.
That's part of it. Now, we haven't seen the catharsis. We've had some guests on saying, VIX 40 hasn't happened, et cetera. But nevertheless, many of the tea leaves that you look at on mood are really, really, I'm sorry, they're pretty grim.
We'll put that question to Sebastian Page in about 50 minutes from now. The CIO of T. Rowe Price coming up very shortly. Futures positive 0.8% on the S&P, a lift again on the Nasdaq by 0.75%. The lift yesterday morning did not stick.
Thank you, Mark Gurman.
It faded pretty quickly, and thanks to Mark Gurman for his write-up of Apple, who will slow hiring next year, but not in all places. We'll keep talking about that too. Yields unchanged, 298.37 from a beautiful New York City this morning. Good morning. This is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Ritika Gupta. The field is narrowing in the battle to replace Boris Johnson as British Prime Minister. Rishi Sunak and Penny Mordaunt were the top two candidates after Monday's voting by Conservative MPs. Another vote today will whittle the field from 4 to 2. A drive in the Senate to quickly pass $52 billion in grants and incentives for American semiconductor makers has picked up steam in Congress. Senate Majority Leader Chuck Schumer says the Democrats and Republicans are hashing out the final details. The legislation is a scaled-down version of a larger bill intended to make the U.S. more competitive with China in technology. And House Speaker Nancy Pelosi reportedly plans to visit Taiwan next month. That's according to the Financial Times, which says there are divisions in the Biden administration over whether Pelosi should make the trip. In April, China said a Pelosi visit to Taiwan would be a malicious provocation. Twitter has dismissed Elon Musk's complaints that he doesn't have enough information about spam and robot accounts. The company called it an irrelevant sideshow, and it urged a judge to hold a trial as soon as possible over Musk's cancellation of his $44 billion takeover. Shares of IBM are lower. Pre-market, the company lowered its forecast for free cash flow this year due to the stronger dollar and the loss of business in Russia. That overshadowed results that beat analyst estimates. Sales show that demand for mainframe computers, consulting and cloud services remains strong. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
This president has pledged to do all he can, you heard him just say that yourself, to ensure that we have an ample supply of oil to ease inflationary pressures, particularly at the pump.
Was Jared Bernstein, the White House Council of Economic Advisors. 4.95, Tom. We're south of 4.50 a gallon. The average gasoline price in America right now, they have been falling prices since the middle of June every single day, and it continues.
We see this in other commodities, too. I'm looking quickly at Chicago copper, John. I know you look at LME, but 334 is a stunning statistic. I'd also note, John, that even with the worry of the food crisis and David Malpass coming up, even the grains are somewhat quiescent as well.
They're getting less greedy, those companies, Tom.
Well, I don't
decided to be generous over the last month and just bring prices down for 35 days.
I have no idea what this headline means. Quickly, John. Heathrow refuelers,
sure,
to go on strike later this week. That's just another inflation strike,
Katie spotted that one. Katie, how much worse is Heathrow going to get over the next couple of months?
It's hard to see how it can. You already have them restricting capacity for the summer, asking airlines not to sell tickets because they literally just cannot handle the passenger traffic. They've been dealing with these labor issues, and now a strike of the people who actually need to put the fuel back in the planes. I can't imagine that helps with the whole delay and cancellation situation that one of the busiest airports in Europe already was
I'll
dealing
do a
with.
test run for us later this summer, Tom. Just for you.
Yeah, futures up 33. The VIX 24.69. Still really constructive, I would say, even off the Apple Mark Gurman gloom yesterday. Emily Wilkins of Bloomberg Government with us right now on a Washington brief. Emily, we've got the Texas grid struggling. We do have heat across the nation. Washington's used to this heat, to be honest. How does the heat affect the politics of the White House?
Well, they don't call Washington the swamp for nothing, and certainly at this time of the year, it absolutely feels like it outside. I mean, Biden is really, when it comes to energy, it's very interesting to see the two sides that he's dealing with right now. Yes, gas prices are coming down, but they are still higher than most Americans are used to, and it still is an issue for the Democrats now trying to get the prices down, as well as going into November with the elections. When I talk with voters outside the D.C. bubble, that's one of the most common things they bring up. But on the other side, he's now facing pressure from the left, from Democratic Senators Jeff Merkley of Oregon, who met with the president the other day and said, hey, if this plan that we had with Joe Manchin to get a number of tax credits for clean energy is off the table, you need to go ahead and declare a climate emergency. And this would open the funding gates for Biden to be able to use funds on clean energy, potentially restrict the movement of some fossil fuels, ban offshore drilling. There would be a number of revenues open to him here if he decides to go that route. We know the Washington Post has reported that this is something the White House is considering. We don't know if or when an announcement will be made. But at this point, Congress is basically throwing up its hands, saying we can't do any more legislation on climate. Biden, it's all you now.
Emily, has that transition, has support for it got stronger or weaker in Washington and across the country, given what's taken place in the last 6 months?
I mean, to a certain extent, it has gotten a little bit weaker because folks realize that gas prices are just the number one short-term concern. And there's a big push to address that in the short term. At the same point, you've got a lot of other folks saying, look, but long-term issues, look at the recent reports we've seen, look at the recent warnings from climate scientists. We really do need to address climate. And that's one of the main things that President Biden ran on, one of the main things he won on. And now he's facing a lot of pressure from voters inside his own party saying, if you want us to turn out for the midterms, if you want our support, if you decide to run for president next year, this is an area that we need to see real action on.
Okay, Emily, so obviously there's the supply side challenge when it comes to oil, the administration trying to address that. There's also been a consistent supply side challenge when it comes to a shortage of semiconductors. And at least it seems we're making some progress on that on Capitol Hill.
Yeah, so we're actually expecting a procedural vote later today on a package that has more than $50 billion for semiconductor manufacturing, really encouraging companies to come to the U.S., produce these chips in the U.S. Although we are starting to see some blowback this morning, the Wall Street Journal's op-ed board noting that the semiconductor industry, it's not where it was a year ago when this legislation was first negotiated. You're actually starting to see the industry have supply meet demand a little bit better than you did. And the editorial board suggested that this could be a case of sort of corporate welfare, giving money to an industry that might not necessarily need it. And so it'll be interesting to see if that becomes a factor today for some of these senators who are going to be placing these procedural votes. Right now, the one message that we've heard from a lot of lawmakers is that they do think this funding is important. A lot of them can tie it directly back to industries within their states. And so I think it's a bit of a question mark on how this is going to play out. But right now, support within the halls of Congress still remains pretty high.
Emily Wilkins, thank you, down in D.C. Tom, some rare news for this president. A 35-day slide in gasoline prices in America. Some rare good news for this president.
I don't know how it's going to turn over into the polling and all that. I think front and center, and certainly for the zeitgeist of the media, is Mr. Manchin and sort of the stasis that we've slipped into, John. But given the heat, and I believe, John, for the next 5 days in New York City, it's what I'm going to call seasonally hot, not like the crisis in London. I wonder how they're going to be overwhelmed by events, including market events. John, this is incredible. This is a bridge, folks. John went to see Fulham Manchester United about 12 years ago and jumped off the Hammersmith Bridge in the Thames.
That's not what happened.
And okay, you were pushed off. But here, John, here it is. It's an impaired bridge, 150 years old, whatever, and they're wrapping it in foil so the cracks don't get crackier.
I tried not to go south of the river, Tom, so didn't use the Hammersmith Bridge.
Yeah, there it is.
But an amazing picture, Tom, of what's taking place.
Yeah.
Any more to say on that? You were very excited about this picture.
I'm not excited. That's the wrong word. But the tail risk here, John, of where this heat is in France. It's supposed to be 100 degrees in Paris. That's normal. But it's really shocking, John, what we're seeing in London.
It's rare to get days like this in the UK. I understand it will fade after today, Tom, and we'll get back to something a little bit more seasonal.
At least for now.
For now.
Yeah.
Are we done?
I don't know. I'm going to look at J&J just out here. Kaylee, thank you for that. Kaylee, tell us about J&J.
Well, on the one hand, you had second quarter COVID revenue up more than expected. It came in at $544 million. The estimate was for just south of $223 million. But the real headline here is that they've cut their full year earnings view to $10 to $10.10 a share. That's down from the previous view of $10.15 a share to $10.35. I'm looking to find the release here as for the why, but obviously we'll dig into those numbers a little bit more throughout the morning, Tom.
We'll come back to that in just a moment. Futures up 0.8% on the S&P. Your euro through 102. We'll talk a little more about what's going to happen at the ECB later this week. 25 or 50 from New York. This is Bloomberg. Yesterday on repeat, I just don't know how we finish. Yesterday, equity futures elevated, then the gains faded pretty quickly. Futures up by 8 or 0.9% on the S&P and the Nasdaq 100, up 0.8%. Bit of outperformance on the Russell, the small caps up 1 full percentage point. Muted price action in the bond market. 2s, 10s and 30s at about 8:30 Eastern. We should get some housing data. We should get some building data as well. The bond market looks like this. 2s, 10s and 30s. Your 10-year yield basically unchanged, 298.93. Your 2-year, 317. What is not unchanged is the situation in Europe. Let's take a look at the euro, the German 10-year, the Italian 10-year as well. A conversation now about potentially a 50 basis point hike from this ECB, 25 or 50. Reporting here at Bloomberg and elsewhere, according to sources suggesting they are considering a 50 basis point hike. Given where inflation is, it makes a ton of sense. Given that the mandate of the ECB is just price stability, 2%, it makes a ton of sense. Given where this situation might be going with gas, Tom, that's where things get a whole lot more complicated, because you have to compare and contrast the expectation for ECB rate hikes with the expectation that Nord Stream 1 might not come back online. And that was the communication we got from the European Commission a little bit earlier this morning.
John, is your reading that it's on or off, or can it be in betweeny?
It could be in betweeny in the sense, Tom, that it could come back online, but you wouldn't see the full amount of gas come through. We saw a little bit of that before it went down for maintenance. The worry is it doesn't come back on at all, Tom. And then you don't get to restock supplies going into the winter. Storage is a big issue.
Yeah, I look at that, John, but I would just say, as you mentioned in the break, Europe has... It's a set of issues that Lagarde has to address at this truly historic press conference.
In a massive way. I didn't even mention Italy, Tom. The good news here is I'm not seeing a massive move on the Italian 10-year, but over the last couple of days we have. The spread's about 200 basis points between a German 10-year and an Italian 10-year at the moment. That was as wide as 240 in the middle of June. So, Tom, we're not out to those kind of levels yet, but the concern about the Italian government, factor that in with the concern about energy supply, factor that into the concern about upside risk to inflation, factor that into the downside risk to growth. What's the optimal policy for the ECB, Tom? And I don't think there is one at this juncture.
It's going to be interesting. John and I could talk about this all day, but we're not on speaking terms. Joining us now, Vasilios Giannakis, head of European FX strategy at Citi. Vasilios, I love what you say about this important ECB meeting, and I'm going to call it the surveillance acronym for July. TPM, which I believe is fragmentation. Are we actually going to see TPM?
Well, I think we're going to get an announcement on the anti-fragmentation tool. I mean, if we don't get an announcement at all, or the very vague and very superficial of the details, then it's going to be all doom and gloom. There's no question about it. We're going to get details. I think the question is, will it be perceived by the market as being effective and able to actually curtail further widening in peripheral spreads? And by and large, I'm referring to BDP boom spread. I think in the near term, it could be. It is likely to have a trigger that is going to include the pace of peripheral spread widening. But you know what, Tom? I think there is a much bigger picture out there. And the big picture is that, one, in terms of the inflation, the ECB is way, way behind the curve. It has a currency that has depreciated significantly, and it's now threatening to have a pass-through into inflation, and it's facing a massive recession risk, to a large extent driven by the increase in energy crisis. Right. And the question is, how do you address that from a central bank perspective? And my concern is that the ECB has been very, very late in actually going into a hiking cycle. Okay, it will start hiking exactly at the beginning of the sharp slowdown.
I got like 8 questions here, but John I know wants to get in. Let me cut to the chase, Vasilios. Is the ECB very late because the Bundesbank wants to be very late?
No, I don't think so. I think the ECB has been very late because it hasn't had a very good read and a very good assessment of developments on inflation. And I don't think that it actually paid particular attention to the geopolitical crisis. And I think I'm very critical of the ECB at this stage. In the last time we discussed, you asked me the question, can you prosecute a central bank at a period of war? And I think that's a very fair point. But you can certainly be critical about its assessment of risks and how it proceeds from here. It should have been, I wouldn't say obvious, because of course I have the benefit of the hindsight, that inflation was setting in, and it was something that the Fed recognized much earlier. So the case for front-loading hikes in order to be able to cushion the slowdown when it came, I think it started becoming quite increasing. It should have started becoming increasingly obvious to the ECB. And I think the ECB has made a tremendous mistake in that respect.
But it's too late now, and this is what we've got. So Vasilios, walk me through it. 25 or 50 on Thursday, and from there, how much further can they go?
Well, that's the thing. That's a very interesting question. First of all, let me say one thing which I think becomes a big danger in the market. Are we going into the era of leaking central bank decisions before they actually go into the desk and into the room and meet? I don't have any information on that, but I'm just flagging that risk. Main scenario for us is 25 basis points, but obviously there is a risk of 50 basis points. But then my question is that front-loading, or is it signaling a more extensive and aggressive hiking cycle? And my take of this is that it's more front-loading, which again is coming too late, and it's unlikely to signal to, or better, to be perceived by the market as an aggressive hiking cycle, because the window during which the ECB can actually hike rates aggressively is getting shorter by the day.
So would you fade this euro strength?
Oh, absolutely. I think it's a dead cat bounce. Look, the euro has far more important issues to contend with, and that is the recession risk. The recession risk, and on top of that, you add an ECB which is not really acting to prop up its credibility. You have Italian politics. You have the big question as to what's going to happen with the Nord Stream 1 pipeline. Unless you get a re-rating higher in the growth outlook, which currently I think is extremely challenging to contemplate, I doubt that one can turn bullish on the euro.
Vasilios, this is a more important question perhaps, and a difficult one to answer. Do you have a decent understanding of the reaction function of this European Central Bank? Because in years gone by, they've had a pretty liberal interpretation of their price stability mandate. When it comes down to it, if Italian yields start blowing out, and we see growth risks really start to pile up, but inflation is still elevated, do they start to focus on the other two and not the one that's ultimately in the story for them, at least meant to be, their mandate?
Right. Let me say the following. I would be lying if I said that I have a very clean understanding of the ECB's reaction function. And I think no one really has a clean understanding of the ECB's reaction function. And to a certain extent, the ECB seems to be moving the goalposts. I mean, look at the 28th of June speech by Lagarde. They've been emphasizing, and Lagarde has been emphasizing and highlighting gradualism and optionality. Right now, on the 28th of June, she said, well, there comes a point where gradualism may not actually be appropriate. So these are of forward guidance, guiding the market to expect this and that. I think it's long past us. The ECB now has to do the best that it can, which means hike rates, but equally at the same time, come very, very with thorough details on the anti-fragmentation. This is going to be about damage control now.
Okay, so Vasilios, how do you model different scenarios of 25-50, gas on, gas off, and how that equates to euro dollar? Because if you're saying this is a dead cat bounce, fade the rally, does that mean we're going substantially below parity? Does that mean 90 cents? Does it mean 95? What are your different scenarios you're playing here?
Right. No, I think that's a very good question. We have, obviously, there are a lot of moving parts that can blend in together. I think if you get the combination of the ECB hiking 25 or even 50 basis points, which I don't think is going to have a lasting impact on the euro. So if you get a hawkish ECB, a relatively effectively perceived by the market anti-fragmentation tool, and at the same time, you get around 40% capacity in the Nord Stream 1 pipeline, you're still talking about severe downside risks and headwinds to growth, which means that the probability adjusted that we come up with our models levels for euro dollar are between 95 and 99, or parity, if you want to call it.
Vasilios, awesome to catch up.
Just phenomenal.
Vasilios Giannakis there of Citi. In that world, Tom, I'm not sure what interest rate hikes would accomplish.
John, I love how you took it to reaction functions. Folks, when we invented this is what we wanted. That was a really serious, nerdy discussion of this huge ECB meeting. And some people are going, okay, why are we doing this? But John, I thought your idea of reaction function and the mathematics of that, the economics of that was tangible. And the answer is, John, is politics part of the ECB reaction function? I'm sorry, politics isn't part of the math. There's too much variance around each coefficient to where, I call it soup. It's soup.
It's not a stretch to bring it up, Tom. More broadly, the relationship between the ECB and the Federal Reserve, what we've seen over the last month, the post-financial crisis framework for communication has totally broken down. We've gone into a Federal Reserve meeting 2 days before that. We had a Wall Street Journal article that teed up a bigger interest rate hike, 75. We've gone into this one. We've had months of communication about gradualism. Only very recently, President Lagarde had the opportunity to tee up 50, and we're still pushing this idea we got 25. And again, right before the meeting, another article, both Bloomberg, Reuters, going with the same story, that it could be bigger. That framework, Tom, has completely collapsed.
Yes, it has, but it's collapsed simply back to Duisenberg and even before Wim Duisenberg. You can take it right back to Monet. I'm sorry. It's Europe. It's not a union.
Futures right now up 0.9% on the S&P. Euro up by more than 1%. A stronger euro. Euro
Did I
dollar.
move the euro there? I was trying.
Probably, Tom, a bit. 102.54 from New York. This is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Ritika Gupta. The European Central Bank may go big when it raises interest rates this week for the first time in more than a decade. Bloomberg's learned that policymakers may boost rates by double the quarter point they outlined last month. The latest Eurozone inflation report showed prices surging to an all-time high 8.6%. The price of oil is holding steady above $100 after posing its biggest one-day advance since May. West Texas Intermediate retained the bulk of Monday's rise of more than 5%. That came after Saudi Arabia declined to commit to output increases following a visit by President Biden. In the UK, temperatures are set to hit a record today. The Met Office says the temperature will likely rise over 40 degrees Celsius, 104 degrees Fahrenheit. The heat wave is disrupting life All across the country, trains have been delayed or cancelled, schools have closed early, and workers have been stranded at home. In China, the number of new cases of coronavirus increased. Nearly 700 infections were reported Monday, the highest number in almost 2 months. More infectious strains of the virus are testing China's hardline approach as outbreaks spread beyond the major cities. And Bloomberg's learned that Anthony Scaramucci's Skybridge Capital suspended redemptions in one of its funds. That followed sharp declines in stocks and cryptocurrencies. The Legion Strategies Fund suspended redemptions because private companies, which are harder to sell, now make up 20% of the portfolio. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
What's important now is whether oil prices have more upside or downside. And in my view, there's more downside, and there's going to be a flip in correlation between equities and oil.
Marco Papic there, the chief strategist at Clock Tower Group. Great to hear from him. Interesting things on China there as well in that interview, if you want to dig it out on Bloomberg.com or on the Bloomberg terminal. Futures right now up 0.9% on the S&P, on the Nasdaq 100 up 0.9%. Also in the bond market, yields unchanged on a US 10-year at 2.99, crude lower by 1%, 101.63. Europe, the epicenter of the action on Thursday, couple of days away. Euro dollar positive more than 1%. Stronger euro, weaker dollar through G10 this morning, 102.52. We can talk about the prospect of a 50 basis point rate hike. I think if you speak to a lot of people in foreign exchange, strategists looking at Europe, they'll tell you they want to know what happens with gas. This from the European Commission this morning. They do not expect Russia to restart the pipeline this week. Here's the quote, Tom. "We are working on the assumption that it doesn't return to operation." They go on to say, in that case, certain additional measures need to be taken.
Oh, that's the story now. And the answer is, I guess you cut down gas, or Mr. Putin sends a lesson in the heat of this summer versus towards autumn and towards winter, where it's a lot more dicey. As you know, we protect the copyright of all of our guests. It's something sacred here at Bloomberg Surveillance. It is their meal ticket. It's how Amrita Sen pays for air conditioning. She's chief oil analyst at Energy Aspects, and her research is absolutely exquisite. She walks through in her latest note why she is structurally an oil bull. Amrita, my head's spinning. Up, up, up we go. Down, down, down we go. Why do you suggest at some point oil gets a bid and moves higher?
Well, that's kind of why I say there's a difference between tactical and structural, right? Like right now, liquidity is thin. People are away on holiday. There's more machines than humans, and we can continue to kind of trade in this very technical band, going up $5 in a day, going down $10 in another day, no problems. But structurally, this is a market defined by underinvestment. We just haven't been investing enough for 8 years now, right? This isn't because of Russia. This isn't because of COVID. It has been going on for a long time. So that doesn't change overnight. And right now, even above $100, there isn't really an incentive to increase investment. And I think that's why we remain structurally bullish this space.
What do you think that means for gasoline prices, with the average price below $4.50 in the United States now, Amrita, a 35-day slide? What do you make of that?
I mean, look, right now, again, these have been driven by recessionary fears. And I still think in the short term, prices can correct lower once again. That doesn't change the fact that overall refining capacity is extremely tight. Remember, gasoline does have seasonality in its favor. We are going to come out of the peak summer driving season, and we do foresee a much weaker winter gasoline pricing. But then next summer, we're going to have, again, very similar high prices, right? Whereas diesel is the one to watch out for. That's really been the tightness in the market. And again, with the European embargo kicking in early next year for products, Russia exports a lot of diesel, about 600,000 barrels per day to Europe. That's where the real tightness is going to be much more than gasoline.
Well, Amrita, we know that the prices at the pump have dogged President Biden for some time. He is trying to take whatever measure he can to get those down in a sustainable way, hence the trip to the Middle East and the visit at Saudi Arabia. The Biden administration seemed optimistic that we were going to see Saudi, the UAE, start to pump more, tap into that excess capacity. What do you actually expect OPEC Plus to do come August 3rd?
We are expecting them to increase production gradually. I mean, look, in theory, the deal ends in December, so they shouldn't be changing anything after they've unwound all the cuts, which was for August, right? Now, that doesn't mean that OPEC Plus are just going to sit on their hands, because not increasing production for 4 months would massively over-tighten this already tight market. So the market is, we're all expecting them to continue adding in small increments, just like they have been over the last 4 months of the year as well. But I reckon the Biden administration will take that as a win. They'll probably spin that as a win and say, look, it's because of the trip to the Middle East, whereas the reality is that that was always going to happen.
Amrita, I want you to describe, just briefly, what would happen in Europe if Nord Stream 1 doesn't come back online this Thursday. What does the situation look like? Where does Germany get its energy from? Just walk us all through it.
So, look, on our balances, we're actually not even expecting them to come back in next week. I know that's obviously the focus in the market. We have been building a scenario where it takes a lot longer to come back. We do think if Russia is actually playing logically and economically, they will have to bring Nord Stream 1 back by the end of October. Otherwise, they will have to shut down fields domestically. That might lead to more long-term damage for their gas fields. So that's yet to be seen. Of course, if they choose to go down a political route, then that's very different. But they still have until October to make that mind up.
Amrita, this is critical because the non-sophisticates like me sort of go, well, if Russia doesn't sell to Europe, they can sell to other people, India, China, et cetera, et cetera. If they have to play with Nord Stream 2, as John is an expert on, can they move the hydrocarbons over to other countries or not?
See, you could do that for oil. You can't do it for gas. Gas in Russia particularly is very, very distinct. The gas that comes to Europe simply cannot be redirected to the east. It will take years to build new pipelines, to redirect the flows, and that's where this becomes a real struggle for both sides, right? And to John's point, that Europe, I mean, you've already seen Germany come out putting measures to cut down consumption, nationalize some of the utility companies. This is just the start. Things are going to get materially worse for Europe when it comes to its power situation.
Amrita, you got to the heart of it. In your assumptions, do you assume that Vladimir Putin is still a rational economic actor?
For now, yes. I mean, that's look. Let's put it this way. We are saying that should Nord Stream 1 not come back by October, then we will very clearly know that he is not. But our base case still is that it does come back, but with a very high probability and risk that it could get delayed further and probably just not come back, because again, that's where the swing factor really comes in. That what's the signal that he's trying to send. But even if it is end October, for Europe, I mean, given the heat wave that's going on right now, the call on gas is very high. And then we just will not be building into the winter. I think that is, I mean, I cannot stress how important that is and how much upside there is to gas prices. One of the things we are seeing right now, with gas so high, we are getting oil back into the power mix as a result of this.
What a tough situation. Amrita Sen, thank you, of Energy Aspects there. Here's a headline for you from the Met Office in the UK. A quote from them: a temperature of 39.1 degrees Celsius has provisionally been recorded in Surrey. If confirmed, this will be the highest temperature ever recorded in the UK. They go on to say, Tom, that temperatures are likely to rise further throughout today.
So through today and then into night. And again, I would go simply to what I read from doctors, which is, particularly for elderly, nighttime is actually more important, John. The temperature's got to come down. Does it come down today? Or as you say, do we wait 2 days or so?
We'll keep you up to speed on that. And, of course, the latest on the ECB as we count you down to that ECB decision. Euro dollar 102.55. We have a stronger euro, a weaker dollar this morning, with equities up 0.8%. This is Bloomberg.
The kind of of economic activity that we are seeing now is somewhat unprecedented.
The inflation story for us, maybe it peaked in June.
It is virtually impossible to craft a story where inflation comes neatly back down to 2%.
I think a lot of countries are having to react because inflation goes up when the dollar strengthens.
When you think about what's going on in Europe, I think the worst case scenario is priced in.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
Live from New York City for our audience worldwide. Good morning, good morning. This is Bloomberg Surveillance on TV and radio. Alongside Tom Keene, I'm Jonathan Ferro. Together this week with Katie Lyons. Equity futures up by 8 or 9% on the S&P. TK, the ECB, writing its own promo for our coverage this Thursday.
Well, we're out front of it 2 days early, and we're out front, folks, 2 days early because it's really, really important, and the research notes on it are absolutely outstanding. I'm going to go to Vasilios Giannakis, John, in the last hour. Great set of guests by our team, by the way, with Citi, where he just says this is Lagarde, and she has lost optionality.
Our latest reporting suggesting she's also doubling down on the effort to come up with that tool, Tom, the transmission protection mechanism, on top of the fact that apparently they're also considering a 50 basis point hike and not just a 25. Then put that together with this one, Tom. This from the European Commission on Nord Stream 1, gas supplies into Europe. We don't expect that it comes back. Tom, we were looking for it to come back this Thursday.
That's a wild card for her, but there, every central banker, John, has wild cards. What the issue here is the elephant in the room, which is from day one, it's been a different structure than the United States. Let's review that quickly. They don't have a combined fiscal policy. And yet on February 24th, David Folkers-Landau of Deutsche Bank told us they're going to need a massive combined fiscal policy. That's the heart of the matter.
And Tom, that's been the heart of the matter for 10 years, but now you have new ingredients to this mess.
It's perfect. It's accentuated.
The new ingredients to this mess is that they face an EM dilemma. Upside risk to inflation, downside risk to growth, and an energy supply story. Tom, the rest of this year for this continent, setting policy for it, I think is almost impossible. You have to try and come up with the least worst option. Right now, Tom, I don't know what that is.
We don't know what that is, and it's wrapped around domestic politics. I would look at Mr. Macron, who's had an eventful 48 hours, including that, $10 gazillion bailout of EDF. I still don't understand that, John. I'll
Trying
let
to close
Javier
that one,
Blas
Tom.
explain it.
We'll let Katie explain that one
Katie
too.
can explain.
Katie, the corporate news later. We turn to tech and Netflix after the bell.
Yeah, how bad are the subscriber losses? Really the question. 2 million losses in the second quarter is what the company has given in its own forecast. So how much downside risk is there to that and the outlook going forward, considering this is a stock down 68%? Yes, Tom.
You channel Scarlet Fu. Come on. Can Ryan Gosling save the franchise with the Gray Man?
I don't know. It comes out on Friday. I'm looking forward to watching it. I think the narrative is that Stranger Things and 11 and all that good stuff is going to help on the subscriber front. But really, to John's point, this is just the kickoff of big tech. And as we have a narrative now of these giant companies slowing down hiring, if not outright laying people off in the case of the likes of Microsoft, that speaks to the broader macroeconomic environment right now. And we saw the effect that had on equities more broadly yesterday, John.
And Kelly, you nailed it. The price action around Netflix.
I thought you meant
after
Stranger
earnings.
Things.
No, you were kicking it off the rails, Tom. Kelly got it back on.
Thank you.
Down 35% after the last report. Down 22% the report before that. What's in store later?
I don't know. Buckle up is what I would tell you, John.
Snapchat in the next week as well, Tom, if you want to have a look at ad spend, and then Apple, I think, on Thursday.
Snapchat still an
next
item?
week. Still going, Tom.
They launched a desktop application yesterday.
I'm not sure it's for
She's a
people
font of
our
digital
age.
knowledge.
That's what I'm here
not
for.
on my phone. Is that still on your phone?
No.
Snapchat?
It's on mine. I
It's
have a
on yours.
1,700-day snap streak with my husband.
1,700.
A what?
1,700 street.
I'll
Tom.
explain it to you. It comes with a little fire emoji. I'll show you in the break.
I've
So
got
you
a
just have to snap
1,700
each other
day.
every single day.
Yep.
John, I've got a 1,700-day streak with Mrs. Keene at shots of tequila.
And she's not talking, she's still.
Yeah,
After all these years. Futures up 0.8% on the S&P. We faded a little bit on the S&P 500. Let's call it 0.75% higher. A similar story on the NASDAQ. Yields come in just a touch, 298.18. Crude, a break of 101, $100 and about 90 cents. We're down 1.6%. You'll notice a lot of dollar weakness out there, including against the euro. Katie, euro dollar 102.55.
Yeah, the question is, are we back at parity come Thursday or potentially even below that? A lot is riding on a lot of different events happening on Thursday. But before we can get there, let's run through the events happening on this Tuesday. There is some economic data here in the U.S. to pay attention to. 8:30 a.m. Eastern time, housing starts and building permits. This data really interesting in light of the fact that we saw home builder sentiment data yesterday falling to the lowest level since May of 2020. So to what extent are we seeing a cooling in housing due to the impact of higher prices and, of course, higher rates? Then after the bell, Netflix will be reporting its results. How bad are the subscriber losses? What do they look like in the third quarter? And what kind of stock reaction will we see, considering we saw a 35% plunge on last quarter's report and the stock is down 68% on a year-to-date basis? Finally, while Tom is taking the surveillance nap, I'll be working an extra long day today on Bloomberg Crypto at 1 p.m. and then the Bloomberg Crypto Summit later on this afternoon. But that is an all-day-long event. Mike Novogratz of Galaxy Digital is going to kick it off, I believe, at 8:40 a.m. Eastern time, and you can watch all that coverage on Live Go, John.
Has he still got that tattoo?
That I don't know if it has been laser removed yet.
You've got to ask that.
Yeah.
Looking forward to that a little bit later. Kelly, great work as always. Bank of America, I'm not going to explain that to you, Tom. The fund manager survey from B of A
Dad shouldn't know.
reads as follows. Record low growth expectations. Did you just refer to yourself as dad? I'm not even going there. Record low profit expectations. Equity allocation, the lowest since 2008. Cash levels, the highest since 2001. Does it get any worse than that? Sebastian Page, CIO and head of Global Multi-Asset at T. Rowe Price, joined us now. Seb, you've called it the stop getting worse moment, SGW. How close are we to that moment, Seb?
I think we're getting there, Jonathan. You know, we still maintain a small underweight stocks relative to cash mainly. We're neutral on bonds. But in our asset allocation committee, we like to lean into bearishness. We like to lean against the wind. And we've started the debate as to when will be the time. We're not trying to time the bottom, but when will be a good time to start buying. The big issue is that while inflation risk, in my mind, is on the way down, recession risk is on the way up. So to add to that gloom and doom, and I tend to be an optimist, but to add to that gloom and doom, you just have to think of the history here of Fed hiking cycles. 10 out of 13 of the Fed hiking cycles have ended in recession. The Fed's never brought inflation down by 4% or more without triggering a recession. So it's recession risk now.
What's so important here, Seb, is T. Rowe Price basically invented buy-side debate, folks. This is even 40 years ago down in Baltimore. Lots of yelling and screaming constructively. And as John mentions, it's a stop getting worse moment as you debate this. And it folds into, on the equity side, into earnings. Julian Emmanuel over at Evercore ISI saying, look, his trend number is a positive 4.8% earnings statistic. That's really not that bad, and that's how you stop getting worse.
You know, it's remarkable, and Golub pointed out that earnings estimates are actually down since March, but they're down less than historical patterns. Just think about this for a second with all the recession talk, the fact that earnings estimates are down a little bit less than they would be historically. And revenues for companies are pretty good, right? We're talking about plus 10% estimates for Q2. That speaks to stocks, corporations having some inflation hedging properties in generating those revenues. But margins are coming down. And again, going back to the B of A survey, you know, I agree that sentiment is quite low. And sooner rather than later, it will be time to start talking about leaning in. If you look at the history of sell-offs, you have 17 sell-offs of 15% or more historically, and the hit ratio in leaning in after those sell-offs is quite high if you look 1 year forward, and you typically make a lot of money by doing this. Just given rising recession risks and still the stickiness in inflation, I just think we're just not quite there yet.
Well, Sebastian, if we break it down regionally, that Bank of America survey showed that among equity investors, they're the most bearish on the Eurozone, which probably makes sense given all of the things that John and Tom were just outlining at the top of the hour, as well as Japan. Is there any pocket of the world in which it is safe to get into equities, in which you feel comfortable taking more risk?
Yeah, it's a great question, because I like to describe our positioning in our asset allocation committee as playing aggressive defense. We're playing defense because we've been underweight stocks all year. It's not a big underweight. We always want to be invested because these are long-term portfolios. But within stocks, we have started to build in some optionality. We're long emerging market stocks from a valuation perspective. It's more interesting. And the risks aren't as big, I think, as they are in Europe with respect to, look, Europe, the consumer is getting crushed. The ECB, Jonathan says this on the show quite often, and I'm a big fan of the show, but there's a very narrow path for the ECB here. The consumer is getting crushed in Europe with lower nominal wage growth than in the US, and still rising energy prices. And you talk about it with the heat wave today. It's just not a good mix. And there's probably more to be priced in here. So, Kaylee, yes, we would lean international on the margin, but mainly towards emerging markets to build some optionality here for this rebound from the bottom that should happen at some point.
Looking for that moment. Sebastian, thank you. Good friend of this show, sir. Sebastian Page there of T. Rowe Price. And Tom, I think I've finished every segment over the last 2 days, multiple times now, by just saying what a tough situation in Europe. And I can't emphasize that enough, that this could get a whole lot harder for the continent as the year grows older.
I'm going to steal from microeconomics here, which is, I know, not the debate, but this strange word, John, ambiguity, and that Christine Lagarde has to synthesize the politics, the economics, the guesstimates, knowing that in so many discussion points, it can cut either way depending on other discussion points. And that's where you get this economic word ambiguity. They're drowning in it right now.
Forward guidance is dead, Tom. And we mentioned this in the previous hour. The post-2008 framework of predictable communication has totally broken down. The fact that we're waking up to another story teeing up a bigger rate hike after months of communication about the first rate hike in the last 10 years, I think that tells you something, doesn't it?
I'm sorry. All central banks are ex-post at every moment. Maybe now they're more ex-post.
Futures right now up 0.8% on the S&P. From New York City, for our audience worldwide, this is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Rishika Gupta. Temperatures in the UK hit a record today. According to the Met Office, the temperature reached 39.1 degrees Celsius in Charlwood, England. That's 102.4 degrees Fahrenheit. The heat wave is disrupting life all across the country. Trains have been delayed or cancelled. Schools have closed early and workers have been stranded at home. The field is narrowing in the battle to replace Boris Johnson as British Prime Minister. Rishi Sunak and Penny Mordaunt were the top two candidates after Monday's voting by Conservative MPs. Another vote today will whittle the field from 4 to 2. Senate Democrats are urging President Biden to declare a climate emergency that could give the president broad authority to redirect funds for clean energy projects or restrict offshore oil drilling. Democrats are shooting down the prospect of swift congressional action on climate change. And China reportedly will fine ride-hailing giant Didi Global more than $1 billion, according to the Wall Street Journal. Beijing will then allow the company to restore its main apps to mobile stores and add new users. Investors have been awaiting the penalties for Didi since China launched an investigation last year into potential violations of data security. And Twitter has dismissed Elon Musk's complaint that he doesn't have enough information about spam and robot accounts. The company called it an irrelevant sideshow, and it urged a judge to hold a trial as soon as possible over Musk's cancellation of his $44 billion takeover. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Rishika Gupta. This is Bloomberg.
Right now, there's this concern that no matter how troubled the U.S. is, there are other countries that are in worse shape. I think a lot of countries are having to react because inflation goes up when the dollar strengthens.
Ken Rogoff there, the economics and public policy professor at Harvard and former chief economist at the IMF, touching on the heart of the issue. Right now, for many countries, many economies, including Europe, futures positive 0.8%. The euro has been a whole lot weaker recently through the whole of this year. Today, some dollar weakness, some euro strength. Euro dollar 102.64. We're positive there by more than 1 percentage point. Your bond market unchanged on 10s, 297.81. Crude down 2%, just about holding on to 100. Tom, $100.55. Kaylee went through the data. You can expect in about an hour and 12 minutes. We will have housing starts and building permits for June. Then it's on to the earnings. It's Netflix after the close a little bit later.
Curve inversion pretty static, John. Negative 19 basis points, pretty much where we were yesterday. It is Tuesday, 2 days away from ECB. That's what we're focused on. Emily Wilkins in Washington is focused on one of the most interesting states. From east to west, Maryland is different, and subtly from north on the Pennsylvania border on down to the evils of Washington, Maryland is different. And what is so different this time is a Republican state that isn't, Emily. It's fascinating how big it was for Biden, and yet Republicans are involved in the debate. What does that say of the uniqueness of these votes today?
I mean, I think part of it, just look at what Governor Larry Hogan, his popularity in the state for the last couple of years. He's consistently pointed to the type of Republican that a lot of Democrats, moderates, and independents can really get behind. And he's backing one of the two candidates in the Republican primary today for governor. The other one is backed by former President Donald Trump and has kind of become a proxy war for what the future of the Republican Party is going to bring. Democrats, of course, also on their side have a competitive primary for governor today. I mean, I think this is going to be just one of those very closely watched races, in part because we don't have a lot of primaries going on in July. This is kind of the big one, but certainly a governor's race to keep an eye on that will tell us something about the future of both political parties.
How is the Trump pixie dust in Maryland versus across the South and across out to Arizona and the debates of immigration and the border?
Well, one trend that we seem to be seeing is that in deep red areas, Trump candidates do really, really well. Look at the South Carolina primary between Tom Rice, where he lost to a primary challenger, mostly because Tom Rice voted to impeach Trump. He has otherwise really solid conservative credentials, but that was enough to lose him in this deep red state. You saw similar things with Republican on Republican matchups. The one that backed Trump usually wound up winning. But then again, going back to South Carolina, you had a district that just sort of leaned Republican. It still had a lot of moderates and independents. This is the district that Congresswoman Nancy Mace currently holds, won again, despite the fact that she was running against a challenger who was backed by Trump. So it kind of shows you that in some of these more moderate areas that Republicans can pull out a win even if they don't have Trump's backing.
The question is whether or not Democrats can pull off many wins, Emily, and whether or not they can keep hold of Capitol Hill come November. The clock is ticking, and I'm wondering how much realistically, legislatively, these representatives and senators are going to be able to get done between now and the midterms that can try to sway any minds.
So it's a lot less than what they were initially looking for. I mean, you're going to see the Senate move ahead with a procedural vote this week that would allow more than $50 billion to go for semiconductor manufacturing here in the U.S. That's one big thing that both Democrats and Republicans want to get done, certainly something that both can run on. And then Democrats are still hoping to pass that reconciliation package, the one that only needs Democratic votes. It's gotten much, much, much slimmer, but it contains two important health care pieces of legislation, one for lowering drug prices, one for expanding Medicare, and Democrats say that they can still run on both of those things. Now, of course, that leaves, though, the bigger issues, which are currently the price of everything. The price of gas, even though it's come down, still pretty high. The price of inflation is really hurting a lot of Americans. That's the number one issue right now, and it's not really clear at this point exactly what Congress is going to be able to do to bring that back down. And so I think there are a lot of question marks now, even if they do wind up passing both of these bills, about how much of an impact that will have come November.
Well, one bill that they're not likely to pass now that Senator Joe Manchin has vetoed it is anything relating to funding for climate initiatives and green projects. Now there's some pressure from Democrats on President Biden to declare a climate emergency. What kind of power would that realistically give him?
Yeah, so Senate Democrats have now been pushing Biden to go ahead, declare this emergency. That would open him up to be able to use some funding and bring that toward clean energy, helping support that. It could also wind up blocking exports of crude oil and ban offshore drilling. So it would definitely give President Biden more power than he might have through, say, just an executive order. But at this point, it's also a signal that Democrats are saying, you know what, we can't pass anything more through the legislative process. We're done dealing with Joe Manchin. Biden, this is completely in your court at this point, and you should go as far as you need to wind up showing Americans as well as loyal Democratic Party voters that Democrats are trying to address climate change, despite the fact that they've got this 50-50 Senate that has proved very, very difficult to move anything through.
Emily, thank you. Emily Wilkins down in Washington, D.C. and TK, I'm pretty sure you called it Maryland just moments ago.
I did. I've been watching Poldark reruns. That's why.
Is that why you're picking up the accent?
Yeah, you know.
Nice, I'm proud of you.
Demelza's causing trouble as usual.
Picking up this move in the foreign exchange market too. Jens Nordvig of Exante Data identifying the big dollar reversal in motion. 3 days of this now, Tom. 3 days and about a 2 percentage point move on the dollar index. I know we've had a big year for the US dollar, but it's quite a move over the last couple of days.
Yeah, it is. I mean, we had a big figure move. I'm looking at what I do, folks, I look at trading envelope, and on Bloomberg Dollar Index, we're not even back to the center tendency after being out +2, even more than that, +2 standard deviation. So, John, I call it an elegant pullback, and I'm sort of like wait and see. I would defer to Mr. Nordvig, Mr. Rochester, and the others for getting more fancy.
I'm in wait-and-see mode for the ECB on Thursday. Euro-dollar 102.59. We've had 2 stories already this morning. According to sources, people familiar with the matter, the ECB is considering a 50 basis point hike, not just a 25 basis point hike. The President Lagarde is doubling down efforts to come up with this new bond tool. At the same time, we've got to deal with the news. Nord Stream 1 was meant to come back online, and the European Commission is leading us to all believe that perhaps, Tom, that won't be the case later this week.
Okay, but devolve it back to economic growth. And the answer is with the Nord Stream 2 uncertainty, with the heat, with the forest fires in France and others. I mean, I'm sorry. Are they going to really raise big into this uncertainty? To me, it's unimaginable.
What would it achieve, Tom, on the inflation front if gas supplies are held back by Russia? Prices are still going to be elevated because of that.
Can you get me cheaper fares to Europe, John? That's all I'm worried about.
Is that all you care about?
Road trip on the brain.
That's all he ever cares
Frankfurt,
about, Kaylee.
Thursday.
Okay.
At least he's consistent.
This is Bloomberg. Waking up to the Bank of America Global Fund Manager Survey, and it is pretty bearish, let's put it that way. Profit and growth expectations, record low. Then you've got the likes of equity allocation, the lowest since 2008. The cash allocation, the highest since 2001. And Mr. Hartnett over at Bank of America saying it's so bearish, maybe I'm bullish.
Is this like
Tom, equity's up 0.8%.
Brahma went away, so you got to step in with the gloom?
That's the fund manager survey. The question I'm asking, Tom, is whether you want to lean the other way. Sebastian Page at T. Rowe Price in the last 25 minutes suggesting that maybe we're getting closer to that moment. Futures this morning elevated by 0.9%. That's the equity picture. Bond market story just briefly looks like this: 2s, 10s and 30s. Yields basically unchanged on a 10-year at 298.18. I'll tell you where to look if you don't want to find a snoozy market. You can find that in Europe, that's for sure. Just this morning, we've had reports of an ECB considering a 50 basis point rate hike. A President Lagarde doubling down on her effort to come up with that new bond buying tool. And Europe, the European Commission, telling us pretty clear that they do not expect Nord Stream 1 to come back online. This is a big, big problem. How much gas will come through that if it does indeed come back online? If it comes back online at all. Euro-dollar 102.61. Tom, we've got a problem in Italy on the political side, on the bond market side. We've got a problem with a single currency, because if you are in this FX market right now and you're trying to make a call on a single currency, it doesn't just come down to rates. In fact, some people might argue that rates are nowhere near the most important thing. It will come down to energy supply through the rest of this year.
So that's a bigger picture. I don't think Lagarde's going to address that. I mean, she's going to have a prepared statement. She's going to look down at it, John. Maybe she'll say something about Nord Stream or natural gas or whatever. I think she's going to focus on economic growth or the lack thereof, and she's going to focus on this fragmentation ballet. Tell me where that's going to be.
You tell me how this works. What are your working assumptions on growth and inflation if there are no underlying assumptions around the energy supply into the continent.
And John, this is really important because it gets to a Jordan Rochester 97, 98 on euro. You've got to take the inflation dynamic, less than the United States, maybe, but the growthiness, the real GDP's got to be way less than the United States.
It's going to get worse, not better, for Europe. Seems to be the takeaway for a lot of people. Euro-dollar right now, 102.61. That's the cross-asset price action. A treat for you this morning. Some single names with Kaylee. Morning, Kaylee.
Well, John, we actually have some single names that are related to foreign exchange as well, because we had earnings reporting from IBM after the bell yesterday. And yes, they topped expectations on the top line, but they cut their free cash flow outlook and disappointed in part due to the absence of the business in Russia, but the other part due to the stronger dollar. And as a result, that stock is down 6% before the bell. And it's a similar story for Johnson & Johnson. Yes, you had a beat in the second quarter. COVID vaccine revenue double what was expected, and yet they had to cut their full year outlook again because of the dollar. So that stock is little change right now in early hours. But clearly this is a theme we're going to be hearing a lot about this earnings season. And earnings will continue after the bell today when Netflix reports. Ahead of that, the shares are up about 1.5% before the bell. But remember, the day after last quarter's report, it fell 35%. Subscribers, absolutely crucial for this company. Finally, one other group of stocks to keep an eye on, crypto-related equities, because you do have a nice little lift happening for Bitcoin. You got Coinbase up about 3.3%, and there's a little bit of deal-related action here as well. Applied Blockchain inking a 5-year agreement with Marathon Digital. That stock is up 28%. Marathon Digital up about 7.7% after a 21% gain yesterday, Tom.
And Kaylee, where will we drive forward the conversation on these future Dow components?
Dow components, like decentralized autonomous organizations, Tom,
No,
or
I think-
Dow, like Dow points that?
No, they're going to enter the Dow here in 5 or 6 years.
We'll see. It's an evolving space, Tom. That much is sure. And remember, Bloomberg Crypto Summit happening all
thank
day
you.
today.
Yes, 1 o'clock crypto with Miss Lyons. It'll
And that.
be good to see. This is a really important conversation right now. Financial media on its invention became a stock derby, so we worry about Netflix, maybe Apple coming up, the bank's just out. And yet Winnie Caesar at Credit Sites knows that bonds have a price. Consider, I'm not going to mention the name, but a blended toothpaste company enjoying a 12-year piece that has gone 117 down to a lovely 90. I think that's called a bear market in bonds. Winnie Caesar says, get the courage and buy IG investment grade bonds. How do you step into IG after it's gone 117 to 90?
Tom, if you liked it at 117, you should absolutely love
There
it
we
at
go.
90, especially after all of the repricing that we've seen in the broader treasury markets. So much of what has happened in the IG market this year has been related to that repricing of duration risk and those expectations for inflation. And every step closer that we get to the potential peak in inflation and the potential end in repricing in duration, the better and more attractive investment grade looks.
How long should our listeners and viewers consider to climb out of the bond bear market hole? Is this a question of quarters or years?
So I do think that it's going to be actually relatively quickly in the near term. But in order to kind of climb out of those total return losses, it is going to take some time, as we do not expect that the Fed is going to really dramatically reverse course and cut rates. Instead, we're looking for some pretty aggressive near-term hikes. And then I think that the Fed is going to relax a little bit and hold things relatively steady to see how the market shakes out. And that means that IG is going to be a pretty good carry trade, but we're not necessarily going to see that massive kind of recompression alpha generating trade that, perhaps investors would hope for after the dramatic total return losses that we've seen.
Winnie, Vishy Terpentore of Morgan Stanley was on this show yesterday, and I was saying, we have spreads north of 500 basis points on high yield. Is that accurately pricing the kind of economic environment you see us heading into? And he said, no, I'm looking for north of 700. What do you see?
So I think that high yield is a really interesting market because the quality composition is just totally different than it's been in any other cycle. If you backtest high yield spreads in the great financial crisis, in the early 2000s, when we saw bigger default cycles and peaks, we estimate that high yield spreads, if it had the same market composition, which is higher quality now, would have actually been, call it 100 to 300 basis points tighter in those peaks. So if you assume that that higher quality composition is truly a tailwind or a net benefit to high yield, the 525 where we are in spreads right now is actually not too shabby, even heading into some sort of economic deceleration.
If default risk broadly is lower in this credit cycle, are there still sectors that are more at risk? Is there going to be a problem sector this time around?
Well, there's always a problem sector, and we always look to where have there been excesses built up? Where have we seen the most amount of bond issuance? Where have we seen leverage really tick up? Now, this cycle is interesting because there's a lot of COVID-specific idiosyncratic factors that drove an increase in debt in consumer discretionary. Telecom was another sector that's really been aggressively issuing debt. And so there are definitely those pockets where you need to be very cautious. One of the reasons that we've been very cautious on high-yield telecom is because of that overall buildup in debt balances really over the past 5 years.
So, Winnie, to be clear here, saying a 3-year, more measured approach, I'm not trying to scalp something or speculate. Are you suggesting bonds are a legit total return vehicle? Clip the coupon, take the gain?
I do think that at this point, higher quality, high yield, and investment grade looks like a much more attractive carry trade than where we were. In the front end of the curve, you're getting very good duration adjusted yield and spread. You're getting compensated for a certain level of credit risk heading into an economic deceleration. You just have to be willing to stomach some day-to-day equity volatility driven by all of the other headlines and that re-rack of expectations.
And finally, Winnie, as we just kind of think about the Fed's reaction function and whether or not it's going to get worried about any aspect of financial markets this time around, how high is the threshold for a Fed put to kick back in? Is it even possible if the Fed wants to maintain credibility in its fight against inflation?
I think the Fed has a really hard time with an outright put amid equity volatility, so long as inflation is as sticky as it has been, or we're not seeing a meaningful decrease in inflation. Now, that being said, I think that the Fed put exists if liquidity to the debt capital markets really dries up. So far, that has not been the case. We've continued to see investment grade and high yield borrowers able to price deals this year. But if that ultimately dried up, that's where I think the Fed put and that conversation would have to start to come into play again.
Winnie, awesome to hear from you. Winnie Caesar there of Credit Sites on some of the big issues in credit right now, pushing ahead to some big central bank decisions. The Federal Reserve, of course, next Wednesday. This Thursday, we'll hear from both the ECB and the BOJ. Just want to go through this European story around the gas issue. We don't expect that it comes back. Nord Stream 1, that was the message from the European Commission this morning. This might have been missed by many of you, it was missed by me. The Commission, according to our team, the EU's executive arm, is due to unveil on Wednesday a plan for coordinated gas demand reduction to mitigate the impact of potential cut-off by Moscow. It is considering, Tom, a set of recommendations to member states, including voluntary reductions to heating and cooling use. The Commission may also seek the right to force consumption cuts if needed later on. I'm not saying that's the base case at the moment. It might be for some of you. But the Commission right now, Tom, is certainly planning for some of the worst of it to take place later this year.
I would say culturally it's hugely different than America. And as one of our guests said an hour ago or so, John, look for protests. It's as simple as that. There's got to be a traditional European response, which is protests. I would suggest that's the shortest path.
You can see why some people might be nervous about buying the single currency with this as the backdrop, Tom. If you do face the prospect of social unrest at a time with political instability on the cards in a place like Italy as well, growth is already getting hammered potentially later this year. That's the call from a lot of people. We still have upside risk to inflation together with that. It's a tricky time to be a policymaker in Europe right now.
I haven't brought it up, John. I don't know where the clock is on this, but what's the likelihood of 5-star running Italy?
Don't know, Tom. I mean, they're not doing well in the polls. Let's put it that way.
Okay.
But that might be because they've been part of this coalition. I don't know. I'm not here to tell you the likelihood of anything happening.
Venice is cooling. The canals of Venice, John, can be cooling. I think, Bramo's on Everest, so, Kaylee can go with us.
Another trip. I'm talking about serious issues and you're planning vacation. Okay.
Surveillance on the Denali in Venice? It's not vacation, it's work.
How expensive is that?
It's like Motel 6.
Yeah, right. Up
the
7/10
motel
on the S&P. From New York, this is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Ritika Gupta. The European Central Bank may go big when it raises interest rates this week for the first time in more than a decade. Bloomberg's learned that policymakers may boost rates by double the quarter point they outlined last month. The latest Eurozone inflation report showed prices surging to an all-time high at 8.6%. Two of the world's largest miners are warning of tougher times for commodity producers. BHP Group sees an overall slowing of global growth in the midst of the war in Ukraine, Europe's energy crisis and monetary tightening. The commentary echoed remarks from Rio Tinto last week. And China is denying a report that President Xi Jinping invited top European leaders to meet him in Beijing and is still waiting for their response. The foreign ministry called the report in the South China Morning Post fake news. The newspaper said the invitations had gone to the leaders of Germany, France and Italy. House Speaker Nancy Pelosi reportedly plans to visit Taiwan next month. That is according to the Financial Times, which says there are divisions in the Biden administration over whether Pelosi should make the trip. In April, China said a Pelosi visit to Taiwan would be a malicious provocation. And Bloomberg's learned that Anthony Scaramucci's Skybridge Capital suspended redemptions in one of its funds that followed sharp declines in stocks and cryptocurrencies. The Legion Strategies Fund suspended redemptions because private companies, which are harder to sell, now make up about 20% of their portfolio. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
Backdrop remains entirely intact. We think credit spreads will ultimately come in, and we think some of this macro uncertainty won't fade, and that's really what's going to drive us higher towards our 4,300 target.
4,300, the price target from Credit Suisse. Patrick Palfrey there and Jonathan Golub looking for a better market in the second half. Equity futures, a better morning, up 0.7% on the S&P. On the Nasdaq, up 0.8%. You saw this movie yesterday, didn't you? And then it didn't end well, Tom, with the news out of Apple that they're slowing some hiring. And all of the above, maybe next year.
Yeah, Mark Gurman with earth-shaking reporting there, of course, one of our great assets at Bloomberg. John, on the Patrick Palfrey thing, what's the bull case now? To me, it's earnings. It's going to surprise. It's going to be okay.
Earnings resilient, this idea that we've seen the worst of it with inflation, that the Fed doesn't have to do as much, that the consumer and corporate balance sheets are strong, and if we get a downturn, maybe even if we get a downturn, it will be shallow and it will be short. That's the optimistic, constructive view of thinking about this market, Tom.
Normally, we wouldn't look at Netflix. I mean, it's like, it's what it is. And John and I sort of go, yeah, bud. And, you know, Lisa, I think's the same way. Kaylee's a little bit glued to it. But this time around is different. Netflix has cratered 72%. I think it was a FANG. Maybe it is still. Geetha Ranganathan is expert on Netflix. She's U.S. media analyst at Bloomberg Intelligence and joins us this morning. Geetha, they're still addicted to a $200 million cost for the Ryan Gosling vehicle, the Gray Man, which Wikipedia has launched out in limited release with a 52% Rotten Tomato. Kaylee Lines tells me 52% Rotten Tomatoes doesn't get it done. How big of a train wreck is this going to be? Do we know yet?
So this is, this has always kind of been the big question for Netflix, Tom. I mean, the quality of some of its film content, but what we've seen and some of the numbers that Netflix reports is that they have some really, really tremendous viewership numbers for a lot of these big budget films. So you look at films like Extraction or Red Notice, they've all consistently pulled in about 90 to 100 million viewers. That is comparable to any big budget release. And so I think when The Gray Man comes out in a couple of days, obviously it has a huge budget, the 200 million budget, the biggest or the most expensive film that Netflix has ever made. I think it's still going to attract a lot of viewers on the platform. The question is how much traction does it get in its theatrical release? But remember, it's only being released in about 400 or 450 theaters versus a normal release, which is in about 2,000 or 2,500 theaters.
Well, it's also a question of how many viewers are even left if we're talking about potentially 2 million subscribers being lost in the second quarter, Geetha. Obviously, a lot of that is going to come from the U.S. There is a sense that the U.S., possibly Europe, is kind of a mature, saturated market when it comes to streaming. Is there anywhere else Netflix is going to be able to tap into to continue growing?
Yeah, so this is really now, Kaylee, become really a tale of two regions, if you will. You know, the developed markets, like as you pointed out, the US and Europe, and you have the developing countries, which, Asia is one of those. So with the US and with some of these more mature markets, obviously they are going to have to take a little bit of a different approach. One of the things has been, will they, go after ad-supported streaming? And I think, yes, they are. We just got some news that they're in a partnership now with Microsoft. We don't really have much details around when they're going to, introduce that plan. It's probably going to be later this year, which means it's not really going to have any material impact till probably another 12 to 18 months. So I think we're going to see continued downward pressure on the subscriber trajectory. I don't think.
Okay, Geetha, I don't mean to interrupt, but I'm looking at the FA screen, which you're in charge of, and the bottom line is Netflix has gone from a double-digit high flyer down to a modeled single-digit. Is this a new single-digit growth technology company? That's the heart of the matter, right?
That is what it looks like, at least for the foreseeable future, Tom. So you're absolutely right. Subscriber growth, pre-pandemic was about 25%. This year, we're looking at about 3% subscriber growth. Revenue growth pre-pandemic was about 30 to 35% year after year. And even last year, even in 2021, after all of the headwinds from the pandemic, the pull forward and all of that happening, we still got 19% revenue growth. We have 8% forecast for this year. So yes, it is looking like it's going to be a high single-digit revenue growth story for the foreseeable future.
Then do they deserve an 18 multiple as on the DES screen?
So the multiples have come down tremendously, Tom. If you kind of look at it on an EV to EBITDA basis, which is how we're kind of looking at most of the media landscape, they're pretty much sitting in line right now, actually even slightly below Disney on a forward multiple basis. So, I would say valuation is attractive because you really look at it from a long-term story. Of course, we're going to have a lot of bumps in the road in the short term, but if you look at it from the long-term story, we're still in pretty much the early innings of this whole transition from linear TV to streaming. And Netflix is the dominant platform. They still, whatever said and done, they still have 220 million users across the globe. They have 2 hours plus engagement on a daily basis. So this is still a pretty dominant force in the media ecosystem.
Well, you talk about all the different subscribers that they have, and of course, those are actual accounts that pay a fee every month, but we know that a lot of those passwords are shared, and we know that in Latin America, Netflix is now trying a new thing where it's going to, if you want to add a household, you charge a fee in places like Argentina, for example. We're talking maybe $3 per account. Are those the kind of numbers that are going to fundamentally change the equation for Netflix? Realistically, is that enough monetization?
Realistically, I don't think so. Yes, maybe it's going to have some effect on the margin. Is it going to be a game changer? I don't think so. So the password monetization is really not a way to drive subscribers. It's really more to keep that ARPU number, the revenue number, kind of growing as much as possible. Ultimately, we really need to get more details on this whole ad-supported tier, because that, I think, can definitely result in moving the needle pretty significantly over the long term, because it does open up the addressable market for a lot of these developing economies where they're really price sensitive, and it could work even in mature economies like the US, where people are getting more and more sensitive to price, where churn is at elevated levels right now.
Geetha, do we trust their guidance on subscribers anymore? Have we given up on that now? Please tell me we have, based on recent experience.
We're conviction is so low right now, John. Yes, I think most the street is really kind of looking for them to kind of match that 2 million loss that they've guided to this quarter. But I think what we're really worried about is more downside pressure for the second half. And this is seasonally, the second half is much stronger, but everybody's worried about some really downbeat guidance.
Geetha Raghunathan there of Bloomberg Intelligence. Geetha, always great to catch up with you. You know the numbers, Tom. 100 million households use accounts paid for by other people. To Katie's point, that's what they're trying to do something about.
Can't they fix that in one day? That's what I don't understand. Why are we debating
You'd think
this?
so. It's a big number, isn't it? 100 million households.
Yeah, John, I look at the impact of this, and I look at Gina in Peaky Blinders, and the Boston linkage into Birmingham, and it is a cultural thing. You have to watch Netflix to really understand
the Birmingham accent
and the accent.
My cousin spoke with that
I just
accent,
watch Regina, but
Do you watch Peaky Blinders?
No, I don't. But
Okay.
yeah,
Best show ever.
I'm trying.
You love
I don't
that,
watch
don't
any
you,
of
Kate?
this. I'm just
Thomas
trying
Shelby,
to
like #1
commune
TV
with like
character of all
Kaylee,
time.
Very cool.
John, and
You still going, Tom?
no, I just
Are you going to practice the accent in the
I never got the
commercial
profit
break?
model on Netflix. I just don't get it.
You're
I've
not
tried.
alone, Tom.
I've tried.
Others feel that way too.
Yeah.
Netflix after the close, then on to next week. Microsoft and Alphabet Tuesday, Facebook Wednesday, Amazon and Apple next Thursday. Busy week next week from New York. This is Bloomberg.
Until the end of the year, Fed is on a continuing hiking path.
They're kind of facing a different inflation demon than they are used to.
Maybe they'd stop at about 3% on the federal funds rate, but they're moving rapidly through neutral into restrictive.
No matter how troubled the U.S. is, there are other countries that are in worse shape.
At the end of the day, U.S. has much higher risk tolerance to conflict in Europe.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
Good morning, everyone. Jonathan Ferro, Lisa Abramowicz, and Tom Keene on radio, on television on a Tuesday looking to Thursday. And it's real simple. John Ferro, we've got to look to ECB, and America has to pay attention. This time, it's not a snooze fest.
It's not a snooze fest at all, and the ECB may be taking a page out of the Fed's book, Tom, by teeing up a 50 basis point hike a few days before the meeting and not 25. Throw in the fact that President Lagarde has got to double down the effort for a new bond tool and recognise the fact that, according to the European Commission, they don't think Nord Stream 1 is coming back online. Stir that all together in the pot, Tom. You've got a pretty messy recipe for the European economy this year.
It is a fragmented Europe, and of course that folds over to this fragmentation. John, we need to stop right now and explain the hope of this policy. Italy, higher yield. Germany, lower yield. And some type of manipulation so Europe takes the price change there on new issuance.
And this is how you
Did
justify
I come
it.
close?
Basically close-ish. Basically, if you get a breakout of Italian spreads, does it impede the transmission of monetary policy across the Eurozone? That's something they're trying to prevent, and that's why they're coming up with this new tool. It looks like, to me at least, Tom, based on recent reporting, that they haven't actually put that tool together yet. So Thursday's going to be interesting for more reasons than one.
You know, name a lot of our listeners and viewers don't know. Philip Lane is more than qualified out of Trinity in Dublin and all of his excellence. Dr. Lane, John, is able to say to Lagarde who picks up the risk if you give Italy a free lunch, right?
Yes, but we need to understand a range of things. The reaction function of this ECB. It just sounds like to me, Tom, they're making it up as they go along.
Right.
At what point do you say that it's an unjustified widening of spreads in Italy? At what point? Do you have a number in mind?
No,
is it the velocity, the rate of change, the speed of the move? What is it? And I don't know the answer to that, Tom, and maybe they're coming up with the answer to that themselves.
Kaylee Lyons with us today as Lisa Abramowicz is on the edge of Everest. Thank you for the note from Nepal earlier with a sighting of Abramo in Kathmandu. I look, Kaylee, at where we are, and yes, the ECB is the focus, but it's also earnings season. And my research note of the day is the Julian Emanuel first calculation of actual earnings growth. Maybe it won't be that bad.
That's the question, Tom, is will we see a continuation of companies being able to pass on higher input costs, retaining margin, as they have proven able to do to this point? The question is that going to start changing if the demand picture starts to change? It's something we're going to continue to look for color on, as well as the idea of FX headwinds. We've had multiple companies now out citing the stronger dollar as a reason earnings won't be as stellar, and not to mention any commentary around the labor force. Apple slowing hiring, Tom. What signal does that send?
Let me start the data check here. New York State Regions. I've only flunked this equation 3 times. John helped me here this morning. 40 times the 9/5, combine that, plus 32 equals 104. Did I do okay, John?
Are you doing degrees centigrade into Fahrenheit?
Yes, we're doing it as a public service.
Why do I have to sit here and translate everything you do every
You
morning?
don't have to translate that. People know this is what we never memorize because we're Americans.
The Met Office saying that London Heathrow has reported a temperature of 40.2 degrees Celsius at 12:50 today, and saying that temperatures are still climbing, so that maybe not the record today, Tom. Perhaps we go even higher. We done with the weather now?
No, what's sad about this is Tang turns into a viscous syrup, John.
Right, I bet it does.
When you're in 40 degrees.
I bet that's disgusting.
Andrew Sheets knows this from Brown University, where they serve Tang in the dorms. He joins us now, Chief Cross-Asset Strategist at Morgan Stanley. And I should say, seriously, futures up 33 with a nice lift off the challenges yesterday. Andrew Sheets, in this July, my head is spinning. Give us the keel of your strategy right now. What is the thing keeping you on a straight and narrow path into Q3 and Q4?
Great. Well, it's great to be here with you. I think a key message is patience. You know, we're in a bear market. We are going through the different cycles and parts of a bear market, but this is a process that still has further to play out. And I think the market has made good progress on the inflation front. You know, we've started to see inflation break-evens come down. I think the market is clearly getting more comfortable with the long-term inflation story. I think we've made good progress in pricing in more from the Fed, but there's still a growth slowdown ahead of us, and we still think that not enough of that is in the price and not enough of that is reflected in earnings expectations. So, you know, there's been good progress. Valuations have adjusted. Sentiment is more negative. Both those things are good, but I think we want to see more signs that we're closer to that trough in growth and that we've seen more resetting in earnings expectations.
You touched on the answer to this question just there at the end there, Andrew. Build on it. You said we're in a bear market. How do you know when we're not in a bear market? And when you get to that point, is it often too late?
Yeah, it's a fair point. I think if we think about, you know, dynamics of this bear market, there's obviously the scale of the drawdown that qualifies. There's the nature of the market leadership, which is very defensive. You know, there's the fact that, you know, we've seen certain conditions that often go along with bear markets, policy tightening, curve inversion, declining PMIs. All of those elements are there. But you're right. You know, by the time the economic data really turns, usually it's too late. So, you know, in terms of things that we're looking for, I think, you know, PMIs being below 50 is usually a better indication that the market is closer to that growth trough. I think we'd like to see more signs that analysts are cutting numbers more aggressively, which is usually a sign that, again, sentiment on the analyst side is getting a lot more cautious. Signs that individual investors are getting more negative on the market, again, I think would be a good sign that you're closer to that trough. And, you know, we're making progress on that front, but I think not quite there yet.
Andrew, looking for that relative outperformance on the way down and hopefully some absolute positive returns too. You guys are focused on defensives. Now, Andrew, some people might hear defensives and they start to gravitate towards some of the tech names. Andrew, I want you to really define what you mean by defensive and why you want to stay there still.
So we've been thinking about defensives in the traditional utilities, staples, healthcare baskets, and those have become more expensive sectors. They've re-rated or relatively re-rated in a pretty significant way, which again is never great. I mean, I think it's a sign of how difficult this market is that the places to hide or the traditional places to hide have become more expensive, which makes it more difficult to hide in them. But you know, we're still overweight utilities and healthcare. We still think the market will gravitate and pay an increasing premium for those sectors as growth risks continue to abound. We think also that the market is underpositioned in those areas still. And, you know, those are areas where we're least worried about growth slowing down. Utilities, because we think the demand is relatively non-cyclical. Healthcare, because I think that's a sector that could actually benefit as demand shifts from goods to services in the economy. Healthcare is very exposed to a lot of services type of spending as things renormalize. So, you know, that's currently still where our U.S. equity strategy team is overweight, where we think investors can still find outperformance, but it clearly has become more expensive as the market has declined.
Okay, Andrew, so that's what you're buying in equities. What else people have been buying over the course of the year so far is commodities and the dollar. How close are we to the peak of those trades?
So we think the dollar can still rise further. We think the DXY will move up to around 112 by the third quarter. So that's a relatively sharp near-term move that our foreign exchange team is expecting. And that's on the back of the fact that we think the Fed is much more likely to meet or beat implied rate expectations than the ECB, where we think weak growth will ultimately raise the risk that the ECB won't be able to hike as much as the market expects, that the Bank of England won't be able to hike as much as the market expects. And on commodities, I think it remains a story of energy versus metals. On the energy side, we still think further gains are possible, especially against the forward curve, which is implying large price declines. We're forecasting higher energy prices into the third quarter. I think the metals case remains much more challenging, where a lot more of that is driven by uncertain Chinese demand. But for oil prices, we think they're moving higher over the next 3 months.
Andrew, did you just say DXY 112?
Yes.
Wow. Andrew, that is a monster move. Andrew Sheets there of Morgan Stanley. TK, missed that one from Morgan Stanley on the FX side of things. They're looking for 112 on the dollar index. You've got to go back to the early 2000s for that kind of stuff, Tom.
Yeah, you do. And you know, you can get out a chart, and maybe I'll do it here on DXY, which is not an EM index. But what does that mean to the Bloomberg dollar index with the EM fragilities? And I know, John, we haven't talked about it. In the last day, I believe Malaysia, India, and somebody else I can't remember. I'll say in Indonesia. I can't remember, but they're all ebbing away. There's some that are stable, but many of the EM currencies have not given up the trend of weakness against the dollar.
Year to date, Tom, the Turkish lira down 24%, the Argentine peso down 20%, the Hungarian forint down 16.6%, the Polish zloty down 13%, the Chilean peso down 10%. A lot of European names in the mix off the back of the Europe story, Tom.
Yeah, on the war in Ukraine and all that. I do get that. John,
Bulgaria, Romania,
where you were going on there, and I think this is the earnings coming up. I think it's later this week. You know, you look at Apple as a profit machine. They've bought back $403 billion of shares modeled over 5 years, 3 years back pandemic, and 2 years forward, moving from $67 billion in 2019 to a modeled $91 billion, I believe, a year and a half out. I don't think enough is made about the banks we just saw, John, and other selected companies. They've moved so far beyond the pandemic.
Well, just how much the outstanding float at Apple has been reduced over the last decade, Tom.
Yeah.
It's just become a cash return machine, hasn't it?
Yeah,
under Tim Cook.
These companies aren't worried about this gloom. They're just moving right on.
Futures up 0.75% on the S&P. Euro dollar 102.50. Positive euro against the dollar by 1%. Counting you down to an ECB decision this Thursday from a beautiful New York. This is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Ritika Gupta. The field is narrowing in the battle to replace Boris Johnson as British Prime Minister. Rishi Sunak and Penny Mordaunt were the top two candidates after Monday's voting by Conservative MPs. Another vote today will whittle the field from 4 to 2. Temperatures in the UK hit a record today. According to the Met Office, the temperature reached some 40 degrees Celsius in Charwood, England. That is 102.4 degrees Fahrenheit. The heat wave is disrupting life all across the country. Trains have been delayed or cancelled, schools have closed early, and workers have been stranded at home. And investors have slashed their exposure to risk assets to levels not seen even during the global financial crisis. That is according to Bank of America's latest monthly survey of fund managers. BofA also found that growth and profit expectations sank to an all-time low. Meanwhile, recession expectations were at their highest since the pandemic-fueled slowdown back in May 2020. China reportedly will fine ride-hailing giant Didi Global more than $1 billion. According to the Wall Street Journal, Beijing will then allow the company to restore its main apps to mobile stores and add new users. Investors have been awaiting the penalties for Didi since China launched an investigation last year into potential violations of data security. And Twitter has dismissed Elon Musk's complaints that he doesn't have enough information about spam and robot accounts. The company called it an irrelevant sideshow, and it urged a judge to hold a trial as soon as possible over Musk's cancellation of his $44 billion takeover. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
If Russia is actually playing logically and economically, they will have to bring Nord Stream 1 back by the end of October. Otherwise, they will have to shut down fields domestically. You've already seen Germany come out putting measures to cut down consumption, nationalize some of the utility companies. This is just the start. Things are going to get materially worse for Europe.
Things will get worse for Europe. We've heard that a lot over the last few weeks. In fact, the last few months. That was Amrita Sen there, the chief oil analyst at Energy Aspects. Equities right now, good morning to you, higher by 0.7% on the S&P. On the Nasdaq 100, firmer too, up 0.75%. We fade just a little bit. There's a huge turnaround in the FX market going on over the last 3 days. Euro dollar now back to 102.41, positive 1 full percentage point. Tom, just keep on fading that dollar move over the last few days.
We're fading it, but it was a ginormous, many big figure move.
Agreed.
I'm going to cut him some slack. A 108 down to a 106.6 on DXY. Some EM stress, as I said earlier, mixed, John. I'm more focused on like the macro, like ECB. What are they going to do? And then we move on. Where are we going to be on Friday, I guess, is my summary.
Staring down the barrel of tech earnings, Tom, next week.
Yeah.
Tuesday, Microsoft and Alphabet. Wednesday, Facebook. Thursday, Amazon and Apple, and the Federal Reserve next week
the
too,
Federal
of course.
Reserve meeting. Are we doing our special? Are we going?
We are doing our special. Yeah,
Okay.
yeah.
My
Are
people,
you taking a day off at some point next week?
No, I don't think so. My people haven't told me if we're doing the 27th.
We are doing the
Glad you're telling
27th.
me. Okay, right now we're going to digress, and importantly digress, with David Malpass. He's president of the World Bank, and with his work at Bear Stearns over the years, a student of detail. And at the World Bank, which is surrounded by experts, much like the United Nations on food, Mr. Malpass has the services of John Baffs. He's out of Greece and out of the United States, PhD from Maryland. And John Baffs, David Malpass, is exquisite on this linkage of energy to food through fertilizer. And fertilizer is something we're not talking enough about. The World Bank is focused on this linkage.
Hi, Tom. That's right. And we have a lot of experts, as you mentioned, and the linkage is pretty tight. The world is going through these two major shifts, one on interest rates and bond yields that you talk a lot about, and it affects currency values. And then on energy, it's reducing that dependence on Russia, which is a huge shift for the world. And it has, I think, several more innings to go to really get it right. Nuclear and natural gas probably are parts of the solution in the long run. But right now, Europe is drawing in natural gas from around the world, which leaves these shortages of fertilizer and food elsewhere.
Does the World Bank have any form of dialogue or new dialogue with Russia and Mr. Putin?
No. That's not what we're doing. We're very involved. Yesterday, I met with the Prime Minister of Moldova right here in this room, and we talked about the major shift going on in Moldovan energy. The electricity grid is being shifted. The natural gas sources are being shifted away from Russia, and that's where the world is heading right now.
As we talk about where the world is right now, and we talk about the prospect of natural gas flows to Europe being cut off if Nord Stream 1 does not, in fact, resume operations come Thursday, we have to keep in mind that also happens against the backdrop of record temperatures in the UK with 40 degrees Celsius just logged. Climate, a very real issue here. And as we talk about investing in some of these more traditional fossil fuel type sources for energy, does that not risk setting us further behind in the long term on climate issues, which we know affect lower income countries more dramatically than others?
Natural gas is cleaner than other fossil fuels, and nuclear is cleaner, is very clean from a carbon dioxide standpoint. I think the world has to really prioritize where it's going with regard to the climate change issues. One of the things we're finding in our diagnostics that we're putting out that are very significant country by country is the things that they can do to protect themselves and to be more efficient in their development practices. It's integrating climate and development that I think is the way forward.
Okay, so investing in development, let's talk about what else you think is vital here. What kind of debt relief efforts do we need to see right now?
This is a major importance for the world because interest rates are going up. The debt was already too burdensome, and now the countries are experiencing currency depreciation, which causes inflation, and they also have a loss of international reserves. So the debt reduction efforts have really been stalled for some years. We know that there are countries that have unsustainable debt. There's not really a process to reduce that debt. We saw that at the G20 just completed last week. No forward progress. I'm hopeful that Zambia may be able to get debt relief in the next few days. There was just a creditors meeting yesterday, so that gives some sign of hope, but it has to be put into practice with actual reduction of debt, massive reduction of debt for some of the poorest developing countries. Otherwise, the poverty rate goes up and the instability that you're seeing in these countries worsens.
David, you've touched on the most important point. The biggest killer is poverty. Do you think the West needs a bit of a reality check about the speed at which it can move away from fossil fuels, given the concerns that you have?
I think there has to be a prioritization of energy policies in the West that includes massive increases in production of less carbon-intensive energy sources. That may lead the world to nuclear and to natural gas because natural gas has the added benefit of producing fertilizer. It's the source of crop yields that is so important for poverty reduction and malnutrition. And so we have to have a direction on that. Right now, Europe is buying up the global sources of natural gas. And importantly, the world is shifting back to coal and even to fuel oil. Every day I meet with global leaders whose countries are either selling coal to Europe or themselves shifting back to more carbon-intensive energy sources in order to try to keep the electricity grids running. So it's a very practical effort by the world to this major shift in energy and in interest rates that's underway.
David, wonderful to get your thoughts at an important time for the global economy. David Malpass there, the World Bank president. Tom, economic nationalism very much front and center when it comes to energy supplies potentially later this year.
And what I would say, John, and I was humbled, this all goes back to Russia 20, 30 years ago. You can think as hard as you can about this. You can listen to people like Mr. Malpass. The bottom line is you never see it coming. You never know where that trip point is going to be.
Crude, a little bit lower today, down by a little more than 1.5% on WTI, $100.75. Futures positive, 0.6%. A little sprinkle of economic data coming right up in New York. This is Bloomberg. You should see how fast Mike McKee runs into the studio to get ready to break these economic data points. He's just getting ready. Futures up 0.6% on the S&P, and the Nasdaq up by about 0.7%. Mike knew the data would come out a few seconds after 8:30 Eastern Time. It's out now. Mike, you got the numbers in front of you?
I don't. I'm having trouble signing into the machine
I'll break them down, Mike.
All right, you break them down, and I will try to figure out why this computer's not working.
Housing starts month on month, down about 2%. Mike, we were looking for a median estimate of 2 percentage points positive. We got -2. Building permits month on month, we were looking for -2.7%. We got -0.6%. So make of that what you will, Mike. Housing starts just a little worse than expected, and I guess building permits a little better than expected.
Yeah, but the building permits are down, and that's kind of the overall question here, is how long are builders going to be able to expand, given the fact that demand seems to be falling off rather rapidly. So with building permits down, it does suggest that we're going to be slowing down. And the question, which will be answered later this week, tomorrow actually, with existing home sales, is when does all this have an impact on prices? Prices have been going up no matter what, which surprises people given the fact that mortgages are higher. And that is feeding into CPI and PCE and causing inflation on the core level to rise. So the question is, can we get that down? When does that start to go down? When do the higher mortgage rates and affordability start to impact the markets? But we did see a really, really bad drop in the home builders index yesterday. They're getting pessimistic, and you can see it in this data today.
Mike, what's the lag time typically between house prices coming down and rental prices getting hit? What's the relationship there?
Well, it's kind of difficult. What the government does is they ask you what you think your house would rent for. And that's how they try to figure out what the cost of housing is. Now, rent prices are obviously available, and we see rent prices going up, but you don't move every week. So you don't really notice the changes in the same way you do with gasoline. So it takes a while. It can take 6-9 months to get into the system. And so the estimates are we're going to see this kind of change going forward for some months in housing. Now, we'll see other things maybe go down, but housing will still be contributing to inflation for a while.
Well, to your point, Mike, on the home builder sentiment data that we got yesterday, the lowest reading since May of 2020. And the chairman of the NAHB, this quote to me just is fantastic. Production bottlenecks, rising home building costs, and high inflation are causing many builders to halt construction because the cost of land construction and financing exceeds the market value of the home. Are you surprised with how quickly things have deteriorated in the housing sector that was so hot for so long?
Not really. I mean, we've saw mortgage rates rise perhaps faster than anybody anticipated because they've been low for a very long time, and then they've jumped to rates we haven't seen in a while. And so the builders are looking out there and they're seeing demand fall off, and we have seen the mortgages go down, mortgage applications go down quite a bit. Now the next step is watch the employment numbers. And we'll watch construction workers. If they start to lose their jobs, that would be the first sort of indication that higher interest rates are pushing up on unemployment, and that's going to be key for the Fed.
The event you went to in Idaho is a precursor for Jackson Hole. Link your Idaho event to what we may see the end of August in Jackson Hole.
Well, the issue is really at Jackson Hole, what does Jay Powell say? And that's going to depend a lot on the data. The general feeling at the Rocky Mountain Summit in Idaho was that the CEOs and economists who were there really didn't know what's going on. They have a bad feeling about things, but the data are inconclusive because jobs have been strong. There's a mix between GDP and GDI, gross domestic income, that doesn't really give a clear picture of how the economy is doing. And yet inflation remains higher, surprises to the upside. So the question is, what does Jay Powell say? And he probably is going to write his speech at the last minute, given that we are waiting for even more inflation and jobs data.
On the plane, Tom, and then they'll give you a tease about the decision in September in the Wall Street Journal.
Tom will be sitting next to him, helping him.
I did that with Kuroda once. But
how did that work out, Tom?
It was lost
you helped
in
in Japanese.
I said, Mr. Kuroda, pick the maroon carpet. That's where we went.
Futures up 0.7, TK. Better morning again. Up 0.8% on the Nasdaq 100.
This is a great joy and perfectly timed. He is Mark Zandi, chief economist at Moody's Analytics. And what you need to know in the absolute depth of 08-09, world coming to an end, GDP, Dr. Zandi was a lone voice saying there will be a recovery and we will get back to 3-ish and 4-ish GDP. And yes, there was volatility and quarter-to-quarter noise, but it was remarkable how he said patience will recover. Dr. Zandi joins us this morning. Mark, just as simple as I can, there's a lot of gloom out there. John talks about a mutual fund manager survey. You know the economic data as well as anybody. Can you look out to better times?
Well, Tom, I didn't realize I had such a track record with you. Thank you. That's kind of you to remember. I think that the most likely scenario remains that the economy is going to navigate through without going into recession. That, there are parts of the economy that are already in recession. You've been talking about housing, that already is taking it on the chin. But the key to continued growth is the American consumer. They're the firewall between an economy that continues to grow in a recession. And, there's a fire and the firewall is under pressure, but I think it'll hold and I think we'll make our way through. So the answer is but, having said that, I am certainly a lone voice. There is a lot of pessimism out there. I've never seen anything like it, from CEO to CFO to investor to man on the street. People think we're going into recession.
And Mark, do you think the risk then is that we talk ourselves into it? You made some headlines over the last couple of days with Mike Regan and our friends in Bloomberg News on their podcast. Do you think there is a real risk of that happening? And how does that actually transpire? How does that come about?
Yeah, I think it is. As I said, I know you can see from my hairline, I've seen a lot of recessions, and I've never seen anything like this where everyone's predicting recession before it actually occurs. Generally, no one's predicting recession, and then we get nailed. But at the end of the day, a recession is a loss of faith, right? It's consumers losing faith that they're going to hold on to their job. It's business people losing faith that they're going to be able to sell whatever they produce. So it's a loss of collective confidence. And so, yeah, I think if we're all talking ourselves into a recession and being very pessimistic, the odds are that we lose faith and we go into recession. I mean, the metaphor I have in my mind is that, we all seem to have our hand on the bunker door. We haven't gone in yet to the bunker, but if there's another loud noise out there, because we're so skittish and so nervous and we've been just talking this economy down, we're going to run into the bunker.
Kaylee, you should see the Moody Analytics bunker. It's got wall-to-wall old value lines going back 30 years.
Well, I hope there's a lot of snacks in there. Mark, you talk about the confidence of the consumer. What about of corporations? Because we have seen a steady stream of not necessarily outright job cuts, but slowing hiring, even from some of the biggest, most cash flow abundant companies out there like Apple, just getting on the margin just a little bit more cautious about that economic outlook. And I'm wondering if you see that bleeding through more broadly into the labor market in the near term.
Well, that's, to some degree by design, right? I mean, the economy's got to slow. I mean, particularly in the job market, we're creating a lot of jobs. At this pace of job growth, unemployment will start moving lower. We'll blow past full employment, and that'll exacerbate the wage and price pressure. So the Federal Reserve is raising interest rates with every intent of slowing growth, slowing down the job creation. If that is happening, you would see layoffs begin to pick up, or at least layoff announcements. And by the way, we're coming off of incredibly low levels of layoffs. I think I don't think I'm dreaming this number. I think I calculated that the number of layoffs in the first half of this year are probably close to record lows. So, you would expect it to pick up to some degree just to be consistent with what the Fed wants.
Dr. Zandi, all want to know, and I know it's a delicate issue, but you're the one to go to here on the revised ADP reports we're going to see. Tell us about that. Is that in process? And what is the new ADP employment survey is going to look like?
Well, Tom, I now stepped away from the ADP, so I don't really have any comments on that. I don't know what they have planned or when they have planned to come up with the data. I don't know.
I thought, John, maybe he had the secrets.
No, I think Mark's telling you he'll continue to ignore the ADP report. Tom,
well,
perhaps. I mean, I don't want to speak for Mark. Just saying.
Don't.
Mark Zandi, Moody's.
And
Mark.
I'm not speaking. Yeah.
I've sensed that too. Mark, good to catch up, sir.
The interview ends successfully.
I think it did, Tom. The risk of a self-fulfilling recession there, Tom, with Mark Zandi.
Yeah. Well, he was very lonely, John, in 08, 09. The hysteria was, you remember. And Zandi said this country will recover. And as you heard there, it's led by 69, 70% consumer. What's the consumer going to do is a discussion at the end of the day.
So I've had a lot of people write in the last couple of hours about the Bank of America Fund Manager Survey, just how many people are forecasting a recession. And, of course, it's the most since we saw back in early 2020. And you see these three peaks, the 08-09 period, the May 2020, the March 2020 period, to be specific. And this period right now, and a lot of people are looking at that and indicating, well, not a big data set, but ultimately these are times where it's been a big buying opportunity in this market. And I got one reply that I think is important. Those peaks coincided or precipitated a massive move in central bank stimulus, Tom. And this time around, given where inflation is, central banks just don't have the space to do that. Now, if, Tom, we didn't have this inflation story in Europe, and I know it's difficult to imagine that, but just kind of put that to one side. If you had the challenges that Europe faced right now in front of you going into year end, we'd probably be talking about an ECB easing, Tom. We'd be talking about the potential for rate cuts from the European Central Bank, and we're not.
We're coming off a natural disaster, and even with the new variants here, I'm sorry, John, we're still coming off of a pandemic. That's the heart of the matter.
Hey, Tom, as we work our way out of that, it's difficult to understand whether what we're seeing right now, pulling back on hiring intentions, is something you should read into as maybe a recession on the horizon, or perhaps just an adjustment based on the massive hiring we have seen over the last few years out of this pandemic. Futures up 0.7%. Around the opening bout, we'll catch up with Greg Peters of PGIM. Looking forward to that in the next hour. From New York, this is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Ritika Gupta. The European Central Bank may go big when it raises interest rates this week for the first time in more than a decade. Bloomberg's learned that policymakers may boost rates by double the quarter point they outlined last month. The latest Eurozone inflation report showed pick prices surging an all-time high of 8.6%. A drive in the Senate to quickly pass $52 billion in grants and incentives for American semiconductor makers has picked up steam in Congress. Senate Majority Leader Chuck Schumer says that Democrats and Republicans are hashing out the final details. The legislation is a scaled-down version of a larger bill intended to make the U.S. more competitive with China in technology. And China is denying a report that President Xi Jinping invited top European leaders to meet him in Beijing and is still waiting for their response. The Foreign Ministry called the report in the South China Morning Post fake news. The newspaper said the invitations had gone to the leaders of Germany, France and Italy. And Halliburton has posted its biggest profit in almost 4 years. The world's biggest provider of hydraulic fracturing is almost sold out of gear in the North American market that includes the most prolific shale oil fields. Halliburton also recorded a $344 million charge related to its winding down of business in Russia. And in the UK, the temperature just keeps rising. According to the Met Office, it broke 40 degrees Celsius, that's 104 degrees Fahrenheit. For the first time ever today, London Heathrow Airport recorded a mark of 40.2 degrees. The heat wave is disrupting life all across the country. Trains have been delayed or cancelled, and schools have closed early. Global News 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
This relentless uncertainty about how aggressive the Fed is going to be, moving by 75 basis points, really no end in sight in inflation rolling over, is something that has caused interest rate volatility to jump 70% from last year, which of course leads equity vol.
Philip Camparelli, he's with JP Morgan Asset Management, really smart there. I love talking to him, particularly about the revenue dynamic that we're going to see. Follow that out with Julian Emanuel of Evercore ISI today, who's really looking at a modeled pretty good revenue growth, 6-ish, and maybe earnings growth of 4-ish, which is not all that bad given the gloom out there. We'll get to that here in a moment. Right now, on the ratios of the moment in equities, Kriti Gupta.
Yeah, Tom, well, let's continue the earnings story here, because as we dive deeper into it, we have to look at this disconnect in the market here, one between sentiment and one between what the actual profit picture looks like. And that really brings me to my chart today. For our radio audience, we're looking at two lines here. One is the S&P 500 going back, let's call it 6-7 years, and the other is EPS, their forward EPS, essentially the estimates that they're expecting. And traditionally, the two lines go hand in hand, and that's usually good news. The idea here being that the stock market follows the fundamentals until you get to this year where you have this massive year-to-date pullback. I think we're looking at a 19% drop year-to-date. EPS, though, still hovering at those record highs. So the takeaway is that perhaps some of these estimates have to catch up to the market a little bit, but traditionally they actually lag what the market prices in. So as we go into this earnings story, really something to watch. Is the market overreacting, or do EPS have some catching up to do?
Right, dovetailed into the Julian Emanuel note, and I'm sure there'll be many others out here as we begin earnings season. Netflix tonight, as John mentioned, tech into next week as well. Kaylee Line's in for Lisa Abramowicz. Thrilled that she could be with us. And now an important conversation with Barry Ritholtz. He's host of Masters in Business, but more importantly, runs real money at Ritholtz Wealth Management, which means he's aged and grayed in the last number of weeks and months.
As we all have.
Are people calling up Barry and saying, proverbially, go to cash?
No, and there's a couple of reasons for that. First, every time we bring on a new client, we explain to them that risk and reward are two sides of the same coin. If there was no volatility, if it didn't make you nauseous when the market drops 20%, well, then how hard would it be to become rich? Everybody would be fabulous Warren Buffett-like investors. You get paid for taking risk. You get paid for other people's behavioral issues, and you get paid for riding out the difficult times. You know, if it was easy, everybody would be wealthy.
You've got a great essay on, I guess, Graham Dodd 101, which is price is compared to earnings. I'm way more modern than that, looking at price as compared to some form of free cash flow, and maybe that's where the debate begins. Should I watch a traditional PE, or do I have to go further to find valuation?
So this is the fascinating question, and it always makes me laugh when people complain about uncertainty. The future is always uncertain. No one knows what's going to happen. Again, if we knew what were going to happen, we'd know exactly where to put our investment dollars. But the fascinating thing about 2022, and we've talked about mean reversion, 2020 up over 20%, 2021 up 28%. So this is a little bit of a normalization, but despite the market dropping over 20%, we're still at record high earnings, or at least the past 2 quarters reporting has shown that. So the key question is, are what we're going to see with the most recent quarter, with the second quarter's earnings that have started this month a little softer, are we going to start to see actual earnings drop? The first half of the year has been all multiple compression, and earnings have remained very robust. How much is the Fed impacting this in Q2? And if they go 75, like they kind of announced through Nick Timiraos at the Wall Street Journal, is that going to really crimp Q3 earnings that we'll see in October?
Well, to that point, Barry, is there a line between an economic recession and an earnings recession? Can we get one without the other?
Sure, you can have a growth recession where instead of this robust $5 trillion worth of fiscal, and let me remind people, we've had 0 rates for a decade and there was no inflation. Clearly, what's going on now is much more pandemic/CARES Act related than the Fed. So if the Fed succeeds in reducing the rate of growth, reducing just the unabated hunger for houses, cars, goods, if we start moving back towards a services economy, yeah, you could see the growth rate slow down and earnings come in, but not have a recession. On the other hand, you absolutely can have earnings stay fairly robust and end up with a mild recession, because what you lose in some of the consumer discretionary and technology, we've gained in energy and I was going to say finance, but some of the big banks have made that clear that that's not necessarily going to go on. However, at higher rates, the big banks tend to do much better.
Okay, so if you were to give me a rate of optimism that you have for the rest of this year, Barry, how you feeling?
So, on the show, I've been saying I don't believe we're in a recession yet. I think all the people screaming that we've been in a recession the past 6 months just really don't understand what the definition of a recession is. And I was hopeful that we could have a soft landing. Monday, that view changed when the Fed announced that they're going 75 basis points. It's hard to see how, with rates that high, and the slowdown that we already see, another 75 basis points, is really going to be slamming on the brakes. I just read this morning, California housing, and this is supposed to be, July is peak of the home buying season, just fell 21%. So we're not in a recession yet, but the Fed seems hell-bent on causing one. And I think, another 75 basis points, and the odds go from, I think the Bloomberg recession forecast was at 38%. I think that's going to tick up well over 60%. And I don't know if it's going to be anything more than a mild recession, but my hopes for avoiding recession are beginning to wane. And with that, what happens with third quarter earnings? Barry,
thank you so much. Barry Ritholtz, Master in Business here on the gaming of recession. Futures up 39, Dow futures up 241, and none of it matters because at 1 p.m. this afternoon, time stands still, where Kaylee Lines will look at the zen of it all. What matters? Is it the Dow DAO or the Dow DOW? Which is it, Kaylee?
Okay, well, for those of those who do not know, DAO, a blockchain DAO, is a decentralized autonomous organization. It is not anything related to the Dow Jones Industrial Average. And that is definitely something that we have talked about on crypto. I'll be talking about it not just on the crypto show at 1 p.m. Eastern time, but at the Bloomberg Crypto Summit, which is happening all day at 2:30 p.m. Eastern. I'll be speaking with Yatsui of Animoca, which is a GameFi kind of company, but we'll be talking about DAOs, NFTs, Tom. I know you'll be waking up from your nap, eagerly waiting to log into LiveGlow on the terminal to watch that.
And I know my invitation to the Bloomberg Crypto Summit, I think that was delivered on Crane Stationery, but I somehow missed that invitation. Crypto, 1 p.m. today. Be there, be square. Speaking of Square, the Dow up 38 points. Square's the next Dow component. Dow up 239 points, I should say. Stay with us through this crypto day. This is Bloomberg.